Everyone here. I would like to handle a few housekeeping items before we get started. We expect this meeting to run till about 12:30. We will take a couple of coffee breaks, and I'm having set times for them. They will depend on how the presentations go. We'll fit them in. We're not planning a lunch break unless the presentations extend beyond the 12:30. Under the Insurance Act and the premium regulations, the Automotive Insurance Rates Board is required to conduct this meeting once a year. As part of the process, the board is holding this public meeting to hear from stakeholders. The purpose of today's meeting is to collect information on the industry-wide costs, administration expenses, and probably any other matter that the board considers appropriate. The review will not address commercial insurance coverage and complaints regarding insurance companies or insurance industry. The presenters will address the board, and there will be only those that have made the application beforehand, which are on the agenda, which is across on the table. And only members of the board will question the presenters. The meeting only forms one piece of the process through which we will establish the rates for this year. Today, I would like to write into the agenda those companies that have made written presentations. State Farm Mutual Automobile Insurance Company, Intact Insurance, and the Cooperators Group Limited. And as a final note, if you take a pencil and pen, I will give you the washroom secret codes, so you can. If anybody wants to steal soap or toilet paper, they have to have this. The men are 18347, and the ladies are 14738. That's the men 18347, and the ladies 14738. And a final note. The meeting is recorded and will be on our website as soon as available. And the written presentations, will be on our website, I think, tomorrow.
End of today.
Tomorrow?
End of today.
Yeah, okay. So with that, we'll start the meeting. And our first presentator is Ted. I can't think of Ted's last name. Oh, one other thing. These are on all the time. So don't whisper back about somebody in the audience.
I'm going to move over here where nobody can throw things at me.
This is Oliver Wyman. Ted, sir.
Testing here. There we go. Okay, can you hear me? That's good. All right, good morning, everyone, and it's nice to see everyone again. A lot of old faces, and it's nice to see Dr. Miller back. We haven't seen Dr. Miller for a couple of years, and good to see him. He must not be happy with something I've done.
I would have brought my referee. I would have brought my referee's coat, if I known he was coming.
After 9 annual industry-wide adjustments, the board turns the page this year and begins a new manner of determining automobile insurance rate changes in the province, a file and approve rate system. And this new file and approve system includes what are referred to as additional coverages or the optional automobile insurance coverages, collision, comprehensive, specified perils, all perils, and underinsured motorist coverages. These are coverages that the board has not had to deal with up until now. So this public meeting serves a different purpose than what it had served in the past. It is not to provide the board with information for the board to consider in deciding by how much all insurers can or are to adjust their basic coverage rates. So I'm not going to be presenting an analysis of the average rate level needs of the industry as I've done in past years. Rather, I will be providing the board with information to enable it to establish benchmarks or guidelines or perspectives against which the individual insurer rate applications will be measured. It is important to note that these are what I'll be presenting are benchmarks to provide the board again with some perspective as it reviews and considers rate applications. It is expected that each individual rate application will stand on its own merits. Each insurer will have to make its case for the rate changes it seeks. This means, for example, that while the board will decide on what it believes to be a reasonable industry average loss development factors or loss trends, it will expect that individual companies will calculate their rate level needs based on their own experience to the extent it is statistically credible. The benchmarks that will result from this public meeting serve another purpose as well. To the extent applicable, they will be used to determine the rate level needs of the grid. Following this meeting, Oliver Wyman and I will be completing our analysis of the grid rate level needs and present a report to the board for its consideration. The board will then decide upon what adjustment, if any, is to be made to the grid rates. Now, the thinking was that whatever loss development factors, trend rates, expense ratios, interest rates, and perhaps profit margin the board accepts as benchmarks, as reasonable benchmarks, that they will be applied to determine the needed adjustment for the grid rates. However, at least as respects loss development, IBC has recommended that loss development factors be based on grid experience rather than industry-wide experience, and we need to give that some thought. One last kind of introductory comment. This file and approve process is new to us all. At least I expect that we'll come across a few kinks in the process that will need to be worked out, and we should all keep this in mind and work to improve the process as we go along. So that's it for my introduction. As I said, we'll be dealing with the coverages that are new to the board. I won't go into them. I think everybody's familiar with them, but they include the collision, comprehensive, all perils, specified perils, and underinsured motorist coverages. Roughly, the premium split, at least from 2013, is almost 50-50 between the basic coverage and the additional coverage written premium. I believe it's a little bit higher in some other provinces. It is more towards the higher proportion for basic coverage, and that the more flatter relationship in this province may be due to rate level adequacy. Perhaps the basic coverages rates are more or less adequate in additional coverage, and sorry about that. And adjustments to rates may more change those proportions a bit. Closer to what we see in other provinces. Claim costs, these are our estimates, Oliver Wyman estimates of the 2013 claim costs, how they're split, and we see, again, a little bit 44% basic versus additional coverages. So roughly 50-50 in terms of premium claim experience in the province. The basic coverage breakdown is, as it has been in prior years, primarily the bulk of it is bodily injury coverage, a little over half of the coverage, the estimated claim cost for basic coverage is coming from the bodily injury sub-coverage, property damage, and then accident benefits, the smallest portion of the basic coverage cost. The additional coverage breakdown is primarily, again, as I said earlier, collision and comprehensive. The three coverages, specified perils, all perils, and uninsured motorist coverages are very minor, each with less than 1% of the estimated claim cost, at least for the 2013 year. Again, so comprehensive and collision coverages are the ones that drive the additional coverages statistics. Just very quickly, some economic metrics that we've showed in past years and now have updated. The unemployment rate for the province has remained pretty much the same as it has over the last couple of years. The CPI, the total CPI has increased close to 2% over last year. Excluding energy, the CPI has increased about 2.5-3% since last year. Gasoline prices, while I know they fluctuate on a daily basis, but at least as of August, at the same point in time, has remained relatively flat over the last 3-4 years. Natural gas prices, after dipping last year, have come back and actually are higher than where they were at the levels in 2011 and 12. Interest rates continue to remain low, running the 3-year bond rates running about just over 1.1%, at least through July, slightly lower than where they were at the same point in time last year, and a little bit higher than where they were back in 2012. And number of insured cars has increased by about 4% since last year, as has the population. Just one graph to show I wanted to show for historical perspective, the interest rate yields. Again, the 3-year yields, as I said, running just over 1.1% currently, nowhere near where they were just a few years ago. And, of course, interest rates are so very important to insurance companies as it represents a source of revenue for them, investment income. The rate filing, what I refer to as guideline components that we'll be discussing this morning, include the following: loss development factors, loss trend rates, what we refer to as the ULAE provision, catastrophe loading, investment rate, health services levy, operating expenses, and profit margin. All of these guidelines, all of these components were considered in prior IWAs. They were again, components to the rate indications that we had presented to the board in prior IWAs, all except the catastrophe loading. This one is new to the board. It impacts or affects the comprehensive coverage only, and I'll be speaking to that. But all the other ones are familiar to the board from past IWA meetings and decisions. I'm going to discuss each and every one of them, but I'll be spending most of my time on loss development factors, loss trend rates, and a little bit of time on the catastrophe loading, but I will go through each and every one of them. Beginning with loss development factors. Now, put simply, I know this is kind of an actuarial term or whatever, but the loss development factors are factors that are applied to the losses that are the claim amounts that are reported by insurance companies to GISA to estimate what the costs will ultimately be, how much insurance companies will ultimately pay out when all claims are reported and settled. Companies report to GISA two sets of numbers, at least as respects claim amounts. They report the amount of losses that have been paid, the amount of dollars they've paid out on claims to date. We refer to these as the lost payments. And companies also report to GISA, the statistical agent, the statistical body, the amount of case reserves that they carry. Each and every company establishes a case reserve on each and every open claim that represents their claim adjuster's best estimate, if you will, of what it's going to cost to eventually settle that claim. And that information is compiled for each and every open claim for each company and is submitted to GISA. So GISA collects from each company the amounts paid and the amounts set in reserve on individual claims. However, it is a well-known fact, a truism, that in aggregate, and this not only applies to Alberta, but it applies to every province, every jurisdiction that I'm aware of in North America at least, every line of business, that case reserves that are established by claim adjusters tend to prove to be inadequate. That when claims are ultimately settled and are paid out, the amounts that are paid out typically are higher than what claim adjusters in aggregate have set aside as case reserves. So the actuaries, recognizing that, established what I refer to here today as the actuarial reserve, also referred to as an IBNR reserve or a bulk reserve, a provision for any inadequacy that might exist in the case reserves. And that number is derived, again, kind of put simply, by applying factors, multiplicative factors to the reported dollar loss amounts, reported claim amounts, that some of the paid losses and case reserves that companies report. Now, each and every company has their own actuaries that does the same sort of thing for their own company, and those actuarial reserves that are established by each company are part of each company's financial numbers, the numbers that they report to OSFI and in their financial statements. GISA, though, does not collect the actuarial reserve from each and every company, and so in order for one to estimate what the industry total claim experience is like, one must come up with or develop the factors that to apply to the losses that loss information is reported to GISA. And we have done that, IBC has done that, and GISA also publishes loss development factors that can be applied to the industry data to arrive at an estimate of ultimate cost. So I'll be talking a bit about the loss development factors because it is a key issue in this particular filing. And the reason why loss development factors are important is because, as I said, they directly lead in or are used to derive the ultimate cost estimates, which in turn are used to derive the trend rates that we also recommend and set to the board. Again, I'll be talking more about loss development in just a few minutes. Trend rates, again, we presented our trend rate recommendations to the board in each and every one of the IWAs, and we again do so today, again, as a benchmark that the board can use to measure trends that are selected by insurance companies in their rate applications. In this chart here, I show the selections we made by coverage last year based on information through the year-end 2012, and I show under the column labeled 2014 selections our current selections as we presented in our report based on the industry claim information through December of 31st of 2013. And you can see that we've increased our trend selections for each and every coverage to some extent. Disability income, it's still a negative number, but it's a smaller negative number, so it represents actually an increase. And collision and comprehensive are new. Again, we have not provided the board with trend rates for those coverages, and you can see on the chart what we're recommending to the board as benchmarks this year. I'll be talking more about trend rates in a few moments as well. The ULAE provision, again, it's something that the board has it's been a component in each and every one of the industry-wide adjustments, but it's something we've really talked about. And I will only briefly say here that first of all, the ULE provision ULE stands for unallocated loss adjustment expense. It's a provision for claim handling costs that can't be attributed to specific claims. For example, if an insurance company hires lawyers to defend itself against claims of insureds or whatever, and those legal expenses can typically be allocated to specific claims. You hire a lawyer to handle a particular claim. That lawyer's fees can be allocated to that claim. Those types of claim expenses are referred to as allocated loss adjustment expenses, or ALAE. Those claim costs are embedded in the claim information that is submitted to GISA. So those numbers we provide for those claim costs in the kind of the normal course of the analysis that we do, because those numbers are part of the numbers that GISA compiles and releases. The unallocated loss adjusted expenses for the salaries of claim adjusters, the rental costs of the office they work in, for example. Claim-related costs that can't be attributed to individual claims is handled through a loading. And we've always accepted, GISA publishes a loading, they perform an analysis, and they release what they believe to be a reasonable loading for the industry on average. And we've accepted the GISA's unallocated loss adjustment expense loading for each and every one of the IWAs, and we do so again this year for purposes of establishing a benchmark or guideline for the board to consider. The difference, though, this year is for the first time GISA has published two ULAE loadings factors, one for private passenger vehicles, 10.7%, and one for total auto, all vehicles, of 9.9%. In past years, GISA has only published one ULAE loading factor, and that was for total auto. So the 9.9% provision is one that it's consistent with the type of numbers that GISA has published in the past. The 10.7% number, obviously a little higher, is new. Why this is important is because the ULE loading gets incorporated into the estimated ultimate cost that we review to select trend rates. And so the ULE, again, is a component of is part of the trend selection process. Since historically, all of our ULE provisions have been on a total auto basis, if we were to use this year the provision for private passenger vehicles, which is, of course, more appropriate for the type of vehicles we're looking at, but nevertheless, if we were to use the 10.7% this year for calculating for trend purposes, would be somewhat inconsistent with prior years, which are all based, for which we all have used the total auto provision. So we're recommending that and that's what we've done in our report, in our trend analysis, we've incorporated or used the GISA's total auto provision of 9.9% in coming up with our trend selections, but suggest that if, for whatever reason, a company needs to determine what the industry costs are for the 2013 year, that for that purpose only, not for trend purposes, but that purpose only, use the 10.7% provision provided by GISA. The cat loading, as I said, is new to the board. Just read here, but the comprehensive coverage, and this relates to the comprehensive coverage only, in particular, claim experience is affected by the occurrence or non-occurrence of weather-related or severe weather-related claims, such as windstorms, hail, flooding. And since these catastrophes, so-called catastrophes, cannot be predicted, it's a generally accepted actuarial practice to remove the actual claim costs arising from catastrophes in a particular year, remove them out of the analysis, and then load back in and perform the analysis, and then load back in a provision for a normal amount of catastrophe losses that would occur in a particular year. Now, we have recommended in our report that a 30% loading be accepted by the board as a kind of a guideline, a benchmark catastrophe provision. Others that will be speaking today and that have submitted written submissions take some issue with the 30%, thinking that it might be too low, that perhaps 35 or 40% loading might be more appropriate. And I will talk more about this in a little bit and show some numbers. Investment income rate, again, important in a couple of respects, but the guideline, the rate filing guidelines allow companies to use risk-free rates in determining their rate level needs. And we have, as we've done in past IWAs, taken a look at the government of Alberta forecasted risk-free rates and presented them in our report. Now, at the time of our report, the government of Alberta, in its budget, was forecasting a risk-free, a 10-year Canadian bond yield of 3.5% for the year 2015 and 1.2% for 2015 as a 3-month Treasury bill rate. We then take those two rates and kind of blend them, if you will, together to try to get a kind of a rate that is more commensurate with the average duration and how long it takes on average to pay out a private passenger automobile claim, which is in the kind of 2 to 3 year range on average. So we kind of weight those two numbers, the 3.5% and the 1.2%, and arrived at, as presented in our report, a blended or melded rate of 1.8% for all coverages combined, a rate that best matches the average claim duration, the average life of a claim. Since we issued our report, the government has updated its budget forecast and has changed its forecasted 10-year Canadian bond rate from 3.5% to 3.25%, leaving its forecasted 3-month Treasury bill rate at 1.2%. So we've kind of reweighted those two numbers and arrive at a 1.7% risk-free rate that best represents the average claim duration. Again, this is based on the government of Alberta's forecast. Now, the board has two decisions it needs to make with respect to investment rates. One is whether or not it will require companies to use, at least for a period of time, the investment rate it selects as a benchmark rate in all rate applications that are submitted up until the board next reviews the investment rates, or whether the board will allow companies to use the prevailing investment rates at the time they submit their filing. So either will the board kind of lock in an investment rate for a period of 6 months or so that must be used, or will the board allow companies to use whatever rate is, again, prevailing at the time? The second decision the board, I think, needs to make is whether or not one size fits all. And by that I mean whatever investment rate the board selects, will it require it be applied to both the rate calculations for basic coverage as well as the rate calculations for the additional coverages, or whether the board wishes or wants companies to reflect that the fact that the average claim duration for basic coverage is a bit longer than it is for the more quicker settling additional coverages, in which case we would recommend not a 1.7% rate for all coverages, but a 1.8% rate for basic coverage and a 1.6% rate for additional coverage. Actually, the spread is not all that much, a tenth of a point, 2/10 of a point, not all that material in my view, but again, it's a decision that the board needs to make, whether, again, it wishes companies to use a different rate for basic versus additional, or the same rate for both. The health services levy, another component. I just bring this up because in actuality, the companies will use the health levy that is eventually announced by the government. As of now, it's my understanding the government has not yet made a decision on the 2015 health levy. The 2014 assessment was $105 million, and the government has had a pattern of increasing that assessment by $5 million a year. So I guess a reasonable estimate or guess as to what it might be for 2015 is $110 million. But again, I would expect the government will be soon announcing what that health services levy is for 2015, and whatever that number is, I would think the board would want companies to use that health levy in their rate applications. So with that, operating expenses. I'm sorry, operating expenses. The little bit of history here, just to remind everyone. For up until and including last year, the expense ratios that we had presented to the board for its consideration, and that the board has accepted with some modification in a couple of years, has been an expense ratio that was that came from a voluntary survey that IBC had conducted for so many years of insurance companies operating in Alberta. That survey, and I may be off the year, but I believe that survey was last conducted in for the year 2011. And then there was a kind of a transition to a new report that GISA is preparing, a financial report, I forget the name of it, that is also now going to be showing or releasing, compiling and releasing in that report expense information from insurance companies. So in a sense, the IBC survey was no longer needed. It's being replaced, at least in part, by the new GISA report. And so IBC stopped doing the survey. I think, again, 2011 was the last year. However, we had a transition year last year. The IBC survey was not performed, but the GISA new report was not yet ready. So the board last year decided to continue to accept for last year's IWA the expense provisions that came out of the 2011 IBC report. So we just kind of carried over 1 year, again, as sort of a transition. The GISA report is now up and running. That's the good news. The bad news is we don't have a GISA report yet for the year 2013. That, to my knowledge, has not yet been published. What we do have is the new GISA report for the year 2012. And I show on this next slide a comparison of the expense ratios that the board selected for the last year's IWA with the expense ratios that are shown in the 2012 GISA report. And you can see overall that the new GISA numbers are 0.7% higher than the numbers from the IBC survey from, again, 2011, I believe that is from. But there's one little wrinkle to all this, and that is that the basis for calculating the expense ratios has changed, and this was brought to my attention by FA. What companies will be, or should be, I think, including presenting in their individual rate applications are expense ratios that are on a direct basis. Direct expenses measured against direct premium. And I would suggest that for commissions and taxes, premium taxes, the base should be direct written premium. All other expenses, perhaps direct earned premium. But the applications that the board will be reviewing should have expense provisions that are on a direct basis. The IBC survey Those numbers are on a direct basis. So they do represent direct expenses as measured against direct premium, although I believe that the denominator, the base against which these expenses are measured is direct earned premium. So a slight difference there. But nevertheless, at least the IBC numbers are on a direct-to-direct basis. It's my understanding that the GISA numbers are on a net basis, net of reinsurance basis. So it's net expenses compared to net earned premium. So the bases are different than what we've been using in the past. I don't think it's a critical issue now because, again, the board will just be using this expense as a benchmark and as a perspective to review company applications. And in those applications, the company should be using their own expense information. But nevertheless, it could be the reason why the numbers have changed by 0.7 of a point since the IBC survey. It simply may be a matter of the base being different as opposed to the expense ratios actually changing. So we have a little bit of an issue here, and to the extent the expense ratios are used to determine the rate level needs of the grid, we have to kind of deal with this as well. I know some others are aware of this issue. I believe it's being looked at. Perhaps there's a way to get the direct expenses out of the GISA report, but I have no further information on that. Something we need to deal with. So I want to now spend a little bit more time on loss development. Sorry, again. First, just a couple of definitions in terms that I went over briefly earlier. When I refer to ultimate claim amount, it's an estimate. It's an estimate of what the insurance companies in aggregate, the industry, will pay out in total on all claims, and I'll be focusing on bodily injury, on all bodily injury claims once all the claims are reported to the insurance companies and settled. And we perform our analysis, as do other actuaries, by accident year. We group all claims, bodily injury claims, by the year in which the incident that gave rise to the bodily injury claim actually occurred. We refer to this as an accident year or an occurrence year. But the ultimate claim amounts that I'll be showing on some slides that are coming up are estimates, except for the very old years where virtually all claims are settled and it's a certainty of what the ultimate costs are going to be. The claim payments, as I said earlier, the amounts paid by insurers on claims. For the most part, those are claims that have closed, but in some cases, partial payments are made on claims that are open. Case reserves, as I said earlier, are the amounts set up by each insurance companies on each and every one of their open claims. That data is compiled and submitted to GISA. It's referred to as case reserves. Again, those are from the insurance companies. And then the actuarial reserve, as I said earlier, is to account for any deficiencies that might exist in the case reserves. And these are estimates made by actuaries. In this case, the numbers I'll be presenting are the estimates made by Oliver Wyman. I believe IBC will be presenting estimates that are based on the work of its actuaries, Dr. Miller, and perhaps other presenters. I'm not aware that any other presenter has come forth with an estimate of the actual reserve needs of the industry. But certainly each and every company has their own actuarial reserve amount for its company, its operations, and as I said earlier, and those numbers are reported to each as part of each company's financial results, but those numbers are not reported to GISA. So we have to derive actuarial reserve estimates on an industry-wide basis. This is a slide that I showed last year, but now I've added an additional column. And let's see if I can handle the laser here. Okay, to explain, let me just walk you through one of the columns. The years on the bottom represent accident years or occurrence years, the years in which, as I said earlier, we analyze claims by the year in which the claim that gives rise to the accident or event that gives rise to the claim, the bodily injury claim, occurred. So the 2008 year, for example, represents all claims that occurred in 2008. The rightmost column represents the height of that column represents our estimate of what the ultimate costs are going to be when all claims are paid out that occurred in that year. The The darker blue number of 300, these are in millions, 349 million, represents the amounts that have been paid so far on claims that occurred in the year 2008 for the entire industry. The 117 million, the kind of the grayish number, represents the amount of case reserves that are carried by insurance companies on the claims that are open from the year 2008. And I will tell you that in 2000, well, I don't have that number, but there's probably about 500 or so claims still open in the year 2008. And the 30 million represents the actuarial reserve, Oliver Wyman's estimate of what is needed on top of the 117 million in case reserves that are carried to provide for all the remaining, call it 500 claims that are still open for settlement purposes. We just think that the 117 million is based on history, is not enough. That's where we are today, based on our analysis of data available through the end of 2013. A year ago, here's what the picture was. At the end of 2012, for the same body of claims that occurred in 2008, $271 million had been paid out. Companies are carrying $172 million in case reserves to provide for the open claims. Of course, there were many more open claims at that time than there are now. And we had an actuarial reserve, or IBNR provision, of $43 million. And the third column to the left there is where we were 2 years ago, at the end of 2012. For the same body of claims, 193 million had been paid out. Companies are carrying 201 million in case reserves, and we felt at that time that a reasonable provision for the actuarial reserve was 50 million. And what this shows is that for the 2008 year, over the last 3 years, we have, by the height of the bar, each bar, we have increased our estimate of what the ultimate costs are going to be for this particular year. And we refer to that as adverse loss development. In hindsight, our estimates have increased. They're higher, so it's adverse development. You can see that's the 2008 year. You can see if we go all the way back to the 2005 year, the oldest year on this particular chart, our numbers haven't changed. Our estimates haven't really changed all that much over the last 3 years, and you would expect that because the bulk of the claims are closed, and there's very little, much fewer claims to be off the mark on, if you will. 2006, you'll see a slight increase of where we are now versus certainly where we were 2 years ago. 2007, our estimate now of ultimate costs higher than we were 2 years ago. We talked about 2008, and then you can see 2009, beginning with 2009, our estimates have more greatly increased over where we were 2 years ago. Here's by the height of the bar. Here's what we thought the ultimate costs would be when all claims are eventually reported and settled. Now here's what we think the picture looks like. We're much higher level than we were 2 years ago. Adverse development. 2010, we see the same picture. Adverse development. We're much higher. Our estimates now are much higher of what this is bodily injury coverage of the cost of claims that occurred in 2010 than they were 2 years ago. 2011, the same picture, the same adverse development that we see. Our estimates now are higher than they were 2 years ago. And 2012, now the first time we looked at 2012 was, of course, at the end of 2012, and here's where we thought things looked like last year. Now looking at the year 2012, we think the ultimate costs are going to be much higher than what we thought they were going to be last year by this amount, the height of the graph. And the 2013 year, we only have one kind of snapshot, if you will, of the year, the claims that occurred in 2013. And here's where we think so far this year is going to end up. So far for the 2013 year, the claims that occurred in 2013 year, of which something like 13,000 are still open. Only 21 million has been paid out. Companies are carrying $289 million of case reserves, and we think the actuarial reserve, needed actuarial reserve in aggregate is about 286 million. These numbers in blue are the Oliver Wyman estimates. Shortly, when I'm done, I think IBC will be presenting other estimates. I think I can say that IBC thinks our estimates are a little bit light, that our provision for actuarial reserves are low by, 5-10% or whatever on the bodily injury coverage, and Dr. Miller will be speaking to that. But the point of this graph is to show that some evidence, signs that things are deteriorating in the bodily injury coverage. The next slide also shows a similar view of things in a little different way. The bars the bars that I show on this slide are identical to the rightmost bars on this slide, although we've added a couple of years. It represents our current estimate of where we think the ultimate costs are going to be by each accident year. The line depicts what our very first estimate of each year's ultimate cost would be the very first time we looked at that particular year. So for example, if we look at the 2008 year, the first time we looked at that would have been at the end of 2008, and at the end of that would have been the 2009 IWA. And at that time, we thought that this year the ultimate cost for this year would be at that level, that height of the bar. Well, you could see now we think it's going to be up here. In fact, you could see that almost the amounts paid by companies so far in the 2008 have almost hit our original estimate of what the total cost would be, and yet there's still a whole 500 claims still open. So the payments have already almost reached the level that we originally thought this year would end up at. The case reserves on top of the payments are well above our original estimate, and now we still think there's another $30 million of actuarial reserve needed for that particular year. I mean, you can see back here the 2007 year, the payments have already exceeded what our original estimate of what this year would ultimately cost insurance companies. And you can see all these years, our initial estimate has proven to be, so far, too low. That based on the information we now have in front of us, the new information that's available through 2011, we have changed our estimates. And again, we discussed this last year, and just more of the same this year. Continue to increase our estimates to where they are, much considerably higher than what our original estimates were. Again, another way of looking at the adverse development, of illustrating the adverse development that is occurring in the bodily injury coverage. Yet another way to look at this is through this slide. Again, this is just bodily injury coverage. It's just a kind of a different way of looking at things. Let me explain this slide. Using the 2009 year as an example. Again, these are accident years. So if we looked at these particular years are points in time. So if we were looking at, if we were back to January 1st of 2009 and took a look at the case reserves carried by companies on open claims from that occurred in 2008, 7, 6, 5, 4, the last 5 years. So if we look at the total amount of case reserves carried by companies as of January 1st or to December 31st, 2008, on those 5 years, the last 5 accident years, the companies are carrying in total just over $1 billion, $1.054 billion of case reserves. During 2009, okay, of the $1.054 billion in case reserves that were carried, $279 million was paid. $882,000 was still carried by the companies as case reserves. So in total, the amounts reported by the companies increased by 10.1%. And these numbers have nothing to do with any actuarial reserve. These are the numbers actually reported by companies. There was deterioration by 10.1% just in 1 year. Again, a comparison of the payments made in 2009 plus the case reserves carried on the very same claims compared to the case reserves that were carried right before the beginning of the year. We see the same, and that 10.1% deterioration is in line with what we saw in 2008, a little bit higher than 7, 6, and 5, but nevertheless, again, in line with 2008. 2009, kind of the same kind of picture, revealed a similar sort of level of deterioration, that things got worse by 11.4%. And again, as I said earlier, we actuaries recognize that the case reserves tend to be inadequate, and this is what this type of deterioration is what the actuarial reserve is supposed to provide for. But the level of inadequacy of we call it 1 year runoff, if you will, has about 10-11% for these 3 years. Then in 2011, the inadequacy, the 1 year inadequacy, increased to almost 14%, higher than the levels we saw over the last 3 years. And then all of a sudden, again, we first showed this last year at the IWA public meeting. We saw in the 2012 a 21% deterioration. That is, of the just over $1 billion in case reserves carried by companies on those 5 prior accident years, $328 million was paid out during 2012. And at the end of 2012, companies were still carrying $927 million on those same claims, a deterioration of 21%. And then again now in 2013, and this is the new information that we didn't have last year, we see further another year of deteriorating results, 22.1%. So something has clearly happened that's causing the deterioration, the case reserve to be less and less adequate than they had been in the past, which causes the actuaries now to increase their estimates of what the needed actuarial reserve is. So certainly all the actuaries recognize this deterioration. The question is how much or how bad are things getting? Another slide, again to illustrate this deterioration we're seeing in the bodily injury coverage. This slide is a presentation of the amounts companies paid out on claims closed in a particular 12-month period. So, for example, for claims that occurred in 2012 that were closed during 2013, 2 years later, companies paid on average $10,000 a claim. For claims that occurred in 2011 that were also closed 2 years later, kind of the same age, if you will, but this would be closed in 2012, an average of $9,000 was paid per claim. So you can see the numbers for 4 years in a row average about $9,000 a claim. A little bit of an increase in 2012, and you would expect somewhat of an increase due to just cost inflation, and probably not every one of these numbers is exactly 9,000. There's some rounding here. But when you get to the picture we see here, though, is a general increase, a pattern of increasing amounts paid for claims closed at kind of at the same point in time. For years, 4 years, we're running in the low to 22,000, 21,000, jumps to 26. All of a sudden, last year, 32,000 paid out on claims closed in 2013 that occurred in 2011. Look at the claims that are 4 years of age. Claims closed 4 years after the year that they occur. For 3 years, are averaging about $70,000 a claim, jumps to $94,000 a claim in 2009, and then last year for claims that occurred in 2009, $137,000 was paid per claim. And so you can see a general pattern of higher and higher amounts paid out by companies on claims closed kind of at the same point in time. More evidence of deterioration. The other thing that you just notice here, that you see the numbers are quite much larger out here than they are down here, and that's because the easier to settle claims, the less costly claims tend to get settled faster. The more challenging claims, the more difficult claims, the more costly claims tend to get closed and settled later in life, and so the costs out here are much greater than they are for here. But nevertheless, when you look down the chart, you'll see a general pattern of increasing costs paid out. This is a chart of the average reserves carried by companies. Again, more evidence of some deterioration. Again, all this is the bodily injury coverage, and you can see here, this represents, as of different points in time, the average amount of case reserves carried by companies per open claim. This number, for example, the 2010 year, 23,000, means that as of the end of 2010, on claims that occurred in 2010, those claims that were still open, the companies were carrying on average $23,000 per open claim in case reserve. That compares to 2011, at the end of 2011, $22,000 per open claim. At the 2012, at the end of 2012, $24,000, and 2013, at the end of 2013, $23,000. So pretty, at least for the initial age, the first year following the year of occurrence, the average reserve was held pretty steadily. But when you look further out in time, you'll see that the average reserves carried by companies are tending to increase. For claims that are 2 years old that are still open, from 45,000 increasing to 52,000. From 82,000 claims that are 3 years old, 82,000 to 110,000. A more significant increase. Claims that are 4 years old, from 102,000 a claim to 157,000 a claim. So you can see again a general pattern of increasing claim reserves carried by companies per open claim. Another indication that things are getting worse than originally anticipated. And finally, one last slide again. I won't spend any time on this, but it just represents the percent of case reserves that were actually paid out during the subsequent year on an accident year by accident year basis. And I realize I'm losing a lot of people on this, but again, numbers are increasing generally. They're showing that more and more is being paid out as compared to the case reserves that were carried. Another indication that things are worse than originally anticipated for the bodily injury coverage. Now, again, as I said earlier, I certainly we believe this is evidence that things are deteriorating, getting worse, adverse development, as I said earlier, in the bodily injury coverage, and hence there's a need to increase the actual reserves that we've previously estimated on each and every one of these accident years. IBC, I know, shares the same view. The difference is the degree to which the actual reserve should be increased. In other words, what development factors should be applied to the reported amounts to provide to estimate the ultimate cost and provide for the actual reserve. I'm aware of 3 sets of actual loss development factor selections that have been presented on the industry experience. Our own that we present in our report to the board. IBC, and Dr. Mill will be commenting on his selections later this morning, and also GISA selects development factors. When GISA publishes their reports, they have a loss development report that they publish, and in that report, they present kind of their view of the world, their estimate of what the development factors one should use and apply to the industry information that they capture to estimate the ultimate losses of the actual reserve needs. And I believe GISA comes up with their factors. I believe GISA has a committee of actuaries from companies that are members of GISA, and they collectively come up with their estimate of what the factors should be. So we have 3 sets of factors to kind of compare against. And of the 3, the GISA selected factors are the highest. The Oliver Wyman Art selected factors are the lowest. They're all higher than where they were last year, but right now the GISA factor is the highest, the Oliver Wyman factor is the lowest, and I believe the IBC factors fall in between, although closer to the higher end of the range, closer to the GISA selected factors than the Oliver Wyman factors. I guess the reason why we have kind of a different view, a slightly different view of slightly lower factors than the GISA or IBC have, and again Dr. Miller will explain his selections, goes back to this chart of the average case reserves. First, just a comment, again, IBC will be talking about this as with other presenters. The reason why bodily injury coverage is deteriorating. We heard last year, we did a little survey last year, we heard presenters last year present anecdotal evidence or information that claimants are now retaining more and more legal counsel. A greater portion of claimants are retaining legal counsel, and they're retaining legal counsel earlier in the process. And typically, there's a correlation between legal representation and the average cost per claim. Other anecdotal information was that the claims, to use IBC's terms, are more subjective. Now, more claimants are claiming hard-to-prove injuries like chronic pain or TMD or TMJ or psychological injuries. Injuries, again, hard to prove, and injuries that are being used to perhaps circumvent the minor injury cap. And so claims that were thought to be subject to the minor injury definition and cap are eroding, getting around the cap. So this is at least the anecdotal information. I don't have any hard evidence of what's happening. We heard from presenters last year. I think we'll hear from some this year. But I do know that, and IBC will be commenting on this, that the type of information that one needs to do a deep dive into what's really happening isn't available through what's reported to GISA. That type of information is only available through a closed claim study, and IBC is undertaking a closed claim study. I believe we'll begin it shortly this summer, and again they'll be talking more about that. But that type of information that is gathered through a closed claim study can be proved to be very valuable and tell us what the heck is going on with the bodily injury coverage. But that aside, we look at this chart and we see that The average case reserves, as I pointed out earlier, are increasing. Companies are putting up more per open claim than they had been in the past. And perhaps, and maybe we're totally wrong on this, but our thinking is that once companies begin to realize that more and more claimants are involving lawyers or they're claiming TMJ or chronic pain, that they're recognizing that sooner and putting up higher case reserves faster. And if the case reserves are more adequate, then there should be, in theory at least, a less of a need for a provision on top of the case reserves to provide for inadequacies. So if case reserves are increasing, all else being equal, the actual reserve shouldn't be as great. However, the big question is whether or not this increase in case reserves that we're seeing is really a reflection of stronger, more adequate case reserves, or the case reserves just as inadequate as they were in the past, but they're just inadequate at a higher level. We've taken the view that, at least to some extent, the reserves are more adequate than they have been, and perhaps have taken a more tempered approach in selecting the development factors that we've selected. Again, what we selected are higher than what we selected last year, but not as high as what GISA and IBC have selected. IBC and GISA, I believe, are just and I fully understand the type of analysis they've done and where they're coming from, what their position is, but they've taken a more aggressive, if you will, approach, perhaps arguably a more realistic approach, we don't know, than we have in selecting development factors. But again, our factors are lower than GISA, lower than IBC factors, and we'll find out as these claims settle over time, what is right, but we don't know for many years. So let me move on to. So that's the issue with loss of again, something's bodily injury coverage. The claim experience is deteriorating. We recognize that. We have anecdotal information as to what's causing that. It's just the actual reserves need to be increased. We believe it's a question of how much, and we're not quite as high as what GISA and IBC suggest. I'm not going to go through this, but I just...
the chairman of all people.
I'm not going to go through these next two slides. I just present them. There's just too many numbers. You can't read. I can't even read them from here. But this is, at least in part, the information that GISA actuaries, Oliver Wyman, IBC, consider in selecting the loss development factors. And just for anybody who's interested, on the bottom there we show the factors that we've selected by time interval and compare them against the factors selected by GISA. And on average, the GISA factors are anywhere between 5 and 8 or 9%. 5 or 8, 9% higher than our factors. So all else being equal, if we were doing a rate adequacy analysis of the industry, applying the GISA development factors would lead one to conclude that the bodily injury coverage needs more of a rate increase than one would get using our factors by perhaps, I'll just pick a number, by 5% or so. Next topic, trends. I am mindful of the time, so I'll try to be quick, but I have a bunch of graphs here that depict the trends that we're seeing by coverage. And again, maybe I'll hold off on that comment in a moment. We see here bodily injury frequency. Estimating what again, not all bodily injury claims are reported right away. It takes some time for all claims to be reported that arise out of accidents that occur. But nevertheless, you can estimate claim frequency rates at fairly accurate degrees, and you can see over time that we haven't changed our estimates all that much of the bodily injury claim frequency. And we show here even the GISA numbers, plugging in the GISA factors. So we're all pretty close together. Not much of an issue on frequency. The one thing that's important to note on frequency is that long-term declining trend that we've been observing has flattened out since now we've seen that it's flattened out for the last couple of years. We're not seeing that bodily injury trend rate decline as it had been. The more important and interesting trend is the bodily injury severity trend. Again, this kind of parallels the discussion we had on the deterioration we've observed in bodily injury, because it's all coming from the average claim cost, not the average claim frequency rate. And you can see by the light blue line, here's what we estimated by accident year the average cost per bodily injury claim to be back in the 2012 IWA. Last year, as depicted by the red line, we increased our estimates to here, quite a significant increase. This year, as depicted by the dark blue line, we've increased our estimates again of what the average severity is by accident year for bodily injury. And you can see we've colored in the GISA numbers. If one applies the GISA development factors, what kind of bodily injury ultimate cost estimates, average severity estimates, when we get using the GISA factors. And so that's that 5 or 8% difference that I mentioned earlier. But you can see that we were off the mark. I mean, there's no way around it. We've underestimated in past IWAs what the average bodily injury severity is, and our current estimate is here, and GISA thinks the estimate is a little bit higher. The combination of frequency and severity produces a loss cost, the average cost per vehicle. And again, here are the lines. Here's where we had estimated the numbers to be. And this is why the loss amount factors are important. It's the loss amount factors that drive each and every one of these points. Here's where we were. We thought the picture was back in the 2012 IWA. We've updated. Here's where we increased our loss cost estimates last year and to this level. We are again increasing our loss cost estimates to this level, and here's what the loss cost estimate would be using the GISA development factors. But based on the dark blue line, our estimate right now, we're selecting, based on the type of analysis that we do, we discuss it at length in our report, a bodily injury trend rate, loss cost trend rate of plus 2.5%, half a point higher than we were last year. So these points, our interpretation of these points, our analysis of these data points suggests that the trend, on average, and again the numbers bounce around a bit, they're increasing by about 2.5% a year. Property damage, I'll just quickly go to the loss cost slide. I don't bother to show the GISA numbers here because our estimates are fairly close. But again, and actually in this case, we've actually come down from our initial estimate back in 2012, and we're selecting a loss cost trend of 2% for the property damage coverage based on the dark blue data points versus 1% last year. Medical accident benefits medical coverage, we're selecting a loss cost trend of 3%. Our as depicted by the dark blue line, our current estimate is a little bit higher than last year, and that also leads to a little bit higher trend selection than what we were last year. But we're selecting or recommending to the board plus 3% as a benchmark versus the 2% trend we selected last year. Disability income, a very small component, but nevertheless it's one that it's important. That has for so many years been on the decline. The numbers bounce around. It's a very volatile coverage. Again, not a lot of claims as compared to the other coverages in this particular coverage. So the numbers do bounce around a bit. We've selected based on the dark blue points, and I know it's hard to figure out how we came up with that number, but a trend, a continued negative trend, but of only 1.5% versus last year's selected trend of minus 2.5%. But that's where we're coming out on this much smaller coverage. Collision, since we haven't seen this coverage before, but you can see the historical frequency rates, which are fairly accurate. We don't expect them to change all that much as the claims close, because these are fast closing. This is a fast closing coverage. But you can see how the frequency has jumped around from year to year. Collision severity has been fairly steadily increasing, the average cost per claim, but with a kind of flattening in these middle years here and then picking up again. And the loss cost, the combination of frequency and severity, you can see that kind of picture. From this, we've selected, I know it's hard to discern trends when you see patterns like this, up and down patterns like this, but we've selected a 2.5% trend rate for the collision coverage based on our analysis. And comprehensive, which is the coverage most subject to weather conditions. You can see how the claim frequency has varied over the years quite a bit, very volatile coverage, although the average cost per claim has been fairly stable, increasing. And we show here the what the loss cost picture looks like. Again, the combination of frequency and severity. Again, as driven primarily by the frequency rate, you see a lot of volatility in this in the cost for this coverage. But the comprehensive coverage, as we discussed earlier, includes catastrophic claims that are kind of random and some years heavy, some years lighter. So on this, as depicted by the red bar, we've removed all the cat losses from the claim experience, and you can see when you remove the cat losses, the comprehensive loss cost is much more stable. I mean, there's some variability, but it's certainly much more stable than the blue line. And based on the red line, we've selected a loss cost trend for comprehensive coverage of plus 1%. And those are our trend selections, and we summarize them here. Again, you saw this, the first two columns earlier are what we picked last year, what we're selecting this year for the board's consideration. And I also show here, because they presented it, the IBC selection. And you can see very close on the bodily injury coverage, reasonably close on the property damage coverage, very close on the medical coverage. We differ a little bit on the disability coverage, and I can understand that. It's a difficult coverage because of the volatility of the coverage to discern trends, but we're coming out at minus 1.5%. IBC, a small increase. Again, it's a small coverage and not kind of material to the big picture, if you will. Collision, we're a little bit higher than IBC, and comprehensive, this is the coverage that we're furthest apart on. But again, I think we did our analysis excluding the CAT claims, and perhaps IBC just looked at numbers in a different fashion. One thing I would do, for the bodily injury, we talk about it. We mentioned this earlier that what we're presenting to the board are guidelines to kind of measure individual rate applications against. And we saw for the bodily injury coverage that we selected a loss cost trend of plus 2.5%, very close to IBC selection of plus 2.6%. It seems like a reasonable trend rate on average for the industry. However, when you look at what's happening by company, you see a very different picture. Now, these I list here, and I've disguised them so you can't figure out who's who. But these are the A through K represent the top 11 writers in the province, and we took a look at how each of the 11 companies' bodily injury loss costs have changed. The trend that is coming out of their data over the years 2007 through 2013. And you can see that, first of all, you can see that nobody is at 2.5%, the average that for the industry that we've selected. Number one. Number two, you see quite a big variation in the trends. One company is running at 14.5% trend a year. It's just remarkable. While two other companies are running at almost minus 2% a year. So while the averages that we're presenting to the board seem fine for the industry, no company is average. And this is an illustration of that. Again, this is not meant to be an in-depth analysis of each company's trends, but it's meant to show that companies have very different claim experience for the bodily injury coverage as well as other coverages, I'm sure. So again, that's why it's important for the board to consider, as it reviews individual rate applications, the actual experience of each individual company. The CAT loading, again, a lot of numbers on this slide, but I just need to share with the board that the thinking behind our selection of the 30% loading, and I realize, again, these are hard numbers to read, so I'll walk through. But we have here, these are numbers by accident year, and in this first column we show the total number of comprehensive coverage claims. And you can see they were 97,000, 98,000 claims in 1993, about 76,000 claims in 2012 that occurred. Those are total comprehensive claims. The second column shows of these total claims how many were considered catastrophe claims, and it's GISA or IBC that define what a catastrophe claim is, and these are the catastrophe claims that were reported by GISA. This next column, we show the number of CAT claims as a percentage of total number of claims, comprehensive claims, and you can see the numbers, how they vary from relatively low percentages, and IBC makes a point about this, that generally for these older years, 1990s through the early 2000s, the percent of cat claims as a percent of total was, roughly under 10% on average. A couple of high years, but more recently, the more recent years, the cat claims represent a higher proportion of total claims. And you could see 2010, 46%, 45% in 2012. This next column will show the amount of the comprehensive coverage claim amounts, the claim losses have been reported. How much are normal comprehensive claims, non-cat claims, and you can see those numbers here, 222 million so far in 2012. And this next column, the amount of losses reported as being attributed to catastrophes, and you can see for the 2012, 167 million have been reported. So when we take the ratio of cat losses to non-cat losses, we get these factors over here in this column here. And these are the kind of, if you will, the historical cat loading, cat factors that would have applied for each and every year. And when you look at the long-term average, I think we have 20 years here, the average of all these points, these factors, these loadings, cat losses to non-cat losses, is 1.29. If you look at the last 15 years, the averages for these points is 1.31. If we look at the last 10 years, the average is 1.36. And if you look at just at the last 5 years, the average is 1.44. Now, we had recommended in our report to the board a factor of 1.30, 30%, which represents more of a long-term average. IBC and some other submissions suggest that things that these numbers are showing that things are changing. That for whatever reason, global warming or whatever, cat losses are becoming more and more prevalent. They're becoming a higher percentage of the comprehensive losses as these more recent data points show, and so a higher than 30%. A long-term average shouldn't be selected. Something more in line with the more recent data points, maybe a 35, 40% factor should be selected. We show below these same averages excluding the high and low data points, and you can see the averages are quite a bit below. When you exclude some of these high data points, the averages do drop down. So really it's a question of whether or not you believe these couple of high data points are indicative of future pattern, future trends, or in terms of catastrophe losses, or are they truly just outliers that will not reoccur. Now, one major important point, we don't have, as you notice here, the 2013 year shown on the chart. That information was not available at the time we produced our report, and my understanding is that information is still not yet available, but it will be available by the end of the month. When that information comes in, I think we have time to reflect this. We'll add it to our chart, and we'll certainly consider that information. And I understand that 2013 was a high cat year, so it's likely that we're going to see a fairly high factor for the 2013 year, and that may very well change our thinking, and I suspect it will. I will listen to the other presenters today. I've read the other submissions. I understand why a 30% factor may appear to be low, and we may come back to the board with a higher recommended factor, perhaps 35% or so. But we want to see what the 2013 information looks like. So quickly, to try to wrap up here, I want to just spend a couple of minutes on the grid. Now, we are in the process of conducting an analysis of the grid experience based on information through the end of 2013. We just haven't yet completed it yet. IBC, Dr. Miller has done an analysis of the grid experience through 2013. He'll be presenting his findings, I believe, when he speaks. He works a little bit faster than I do. But we will be finishing that analysis in the next couple of weeks and sending a report to the board with our findings of the grid experience, including information through 2013. But I take this chart comes from a report we presented to the board last year based on information through 2012, where we compared what we refer to as the loss ratio, claim amounts as a percent of premium for risks that are rated on the grid against risks that are rated that are not on the grid. And our analysis showed, again, this was a year ago, that overall for these last 5 years, the average difference was 4 points, that the loss ratio was higher, and a higher loss ratio is indicative of less adequate rates, more of a greater need for a rate increase than a lower loss ratio. And our analysis showed that over the 5 years that we looked at, the 5 accident years, there's about a 4-point spread, the grid loss ratio being higher than the non-grid loss ratio. And the last year, 2012, you see about a 3-point spread. Again, this was based on information through 2012. We also noticed that so that led to our thinking that while the grid loss ratio is a little bit higher, and both the non-grid rates and the grid rates are probably inadequate, as our last year's IWA analysis suggested that on average the industry rates are inadequate, the relative difference between the two wasn't all that great. IBC, I'll come back to this chart in a second. IBC, if I pull the numbers correctly, hopefully I did, shows that based on its analysis, including data through the end of 2013, that there's a bigger spread between the grid and they show here the total loss ratio. So if I had the non-grid loss ratio, there'd be even a greater spread than what we had seen based on the data in our analysis through the data through 2012. We're looking at, again, quite a higher loss ratio, grid versus total. One side comment, can't compare these loss ratios to the loss ratios that I showed on the other slide. I think IBC includes the health levy costs, for example, and perhaps there might be some other differences in the way we calculate the loss ratios. What is important is the relative difference, the spread between the two. And again, so IBC is finding that the grid loss experience is much worse than the non-grid experience than our earlier studies would suggest, and again, the study that we are updating. But one last point. In our 2012 study, and we'll be updating this based on the information through 2013, we found that if you exclude from these loss ratios the very best experience, which is grid step minus 15, for those of you that are familiar with the grid, every year you have good claim experience, you move further and further down on the grid to lower and lower grid steps, and which leads to lower and lower rates. The very best risks are at grid step minus 15. If you exclude grid step minus 15 from the analysis, we find that the grid loss ratio, again, this is our analysis, not IBC's analysis, the 82% still didn't change. It's still 82. Without the very best, the grid risk, it's still 82. But the non-grid loss ratio changes quite a great deal. From 78% for the 5-year average to 87%, suggesting that the very best risks on the grid, that are not on the grid, are subsidizing those that are not in class minus 15. So, we're going to be talking about subsidies later. The other presenters will be talking about the dangers, if you will, of the grid risk being subsidized. But this kind of suggests questions. What does subsidizing mean? I see this as the very best risks, non-grid risks, are subsidizing other risks that are not on the grid, but nevertheless are having poor loss experience. I had some numbers in front of me, but I can't find them now. Let me just check. No. All right, so that completes my presentation, I think. Yes, it does. And any questions from the board? I will have it.
Thank you, Ted. I think I have a couple of business things I forgot beforehand. Would everybody turn off their cell phone? And those that remember, Susan has been with us since we started this board, is retired last month, and we have Vivian Coe as our internal actuary. Vivian, you meet people today. And for those that are seasick from watching Ted's red button go up and down,
including
around,
me,
we'll have a break for about 15 minutes, and then I'll call on the board for questions. So then there's coffee at the back. Thank you. All right, if we can have everybody take their seats, please. Now I'm going to proceed around the room with my members and ask for anyone has questions. So we'll start over on the far side in the ladies' section.
I have none for now.
You're on. Do you have questions?
For this gentleman? No.
Yeah,
For Ted?
No.
No, not mine.
Questions? Questions? Question?
No. I just have one. Ted, on the loading with 30%, the Oliver Wyman using a longer tail, is that based on what do you base that longer tail on?
No, only that catastrophes by definition are somewhat random and frequent, and I believe one needs to look at a long-term average to select a representative factor. But that assumes that the numbers over the long history are indeed random, but others are suggesting that that's not the case, that there's a pattern of increasing factors, and so the long-term average that we've used may not be appropriate, that there's something's happening, whatever you want to call it, causing the cat losses to be greater, increasingly greater and greater each and every year on average, and so one should look at a more current history, shorter history of time to be more reflective of what's been happening recently. But if you believe that cats are random and frequent, and there is no pattern that's showing up in the numbers, then the longer history, I think, would be more appropriate. That's kind of where we came out originally. We're rethinking that now.
All right. Thank you. I have no other questions.
Mark, no questions? Well,
Mr. Chair, just one correction for the record. I had misspoke earlier. I had said that the GISA development factors that I presented were selected by a committee of actuaries of member companies that belong to GISA. I was corrected during the break that the GISA factors are selected by their actuarial consultant. I believe it's E&Y. So GISA has an actuarial consultant that selects the factors for them.
Ted, I think everybody in the audience knows what GISA was, but maybe there's some that don't. Maybe you should just say what that stands for.
So I believe it stands for General Insurance Statistical Agent. I hope I'm close. Agency. They collect the information that is reported into the Superintendents of Insurance Automobile Statistical Plan. So they're the data gathering organization. They collect data from the insurance companies and compile it and prepare reports and publish those reports that are helpful for companies, for actuaries or companies that wish to analyze industry experience.
Thanks, Ted. Thank you very much for your presentation. The board will certainly take it into consideration in their preparations, and we'll look forward to questioning you maybe more at a later date. Next, we have the Insurance Bureau of Canada. Would they come forward, please?
Good morning, and thank you for the opportunity to be here to participate in the AIRB's annual review of auto insurance costs and premiums for basic and, for the first time, additional coverages. We believe that such annual reviews that bring together industry, government, consumer representatives, and other stakeholders to discuss automobile insurance are important for ensuring that a competitive and a stable market for consumers remain. My name is Bill Adams. I'm IBC's Regional Vice President for the Western Pacific region. I am joined this morning for our presentation on my left, Dr. Ron Miller, who you've heard referenced a number of times and we'll be hearing from in a moment, IBC's consulting actuary from Barron Insurance Services. And on my right is Ryan Stein, IBC's Director of Policy. As you know, this annual review is the first under the new premiums regulation, as we've heard from Oliver Wyman in the previous presentation. We believe that the new regulation with a file and approve process for both basic and additional coverage will promote a more consumer-focused market with more innovative insurance products at prices that better reflect a consumer's individual driving characteristics. We've divided our this morning's presentation into 4 sections. In the first, Dr. Miller will share his findings on the cost experience for the grid population. In the second section, Dr. Miller will then review Oliver Wyman's loss development analysis and future trend rates. In the third section, Ryan Stein will discuss the cost pressures insurance companies are experiencing here in Alberta. And finally, I'll return to summarize IBC's recommendations to the board. So with that, I'll pass the microphone to Dr. Miller.
Thank you, Bill. Okay. This slide shows the differential loss experience between the grid population and the total market. As you can see, loss costs for basic coverage for the grid population have been consistently higher than loss costs for the total market. Between 2009 and 2013, for the grid population, loss costs increased by 18%, but for the total market by only 10%. The average loss ratio for the grid population during this period was 92%. For the total market, average loss ratio was 85%. As Ted had noted when he pulled out numbers similar to this on the loss ratios, the differences between either non-grid and grid, or in this case total and grid, are larger in our analysis than in Ted's previous analysis. Part of the reason for that is the health levy. I think Ted mentioned that in our numbers the health levy is included, and it's not included, I believe, in his numbers, if I understood him correctly. And the health levy is levied as a percentage of premium. It's currently of the order of 5%. For the total population last year, that represented less than $30 per car, but for the grid population it was about $70 per car, so part of that difference is explained by those. Two factors were the main contributors to the poor underwriting results for the grid population: high and rapidly escalating bodily injury claims costs and the shortfall below actuarial expectations of recent adjustments to the grid-based premium. The underwriting results indicate that a significant difference exists between the average street premium and the average required premium for basic coverages for policies rated on the grid. In turn, they also indicate the need to continue adjusting the grid-based premium upwards in policy year 2015. This slide shows the 2013 loss development factors by subcoverage as well as factors from Oliver Wyman and Giza. The factors derived from the three analyses are rather close to the principal exception being bodily injury, where Oliver Wyman's factors are lower, and this was discussed at some length by Ted in his presentation. This slide goes back a little farther and shows 2010 to 2012 cumulative incurred amount loss development factors for BI, and basically presents a similar picture to what Ted presented earlier. And as noted, my analysis and Giza's analysis are pretty close, and Ted's analysis, for the reasons he stated, are somewhat lower. Ted has suggested in his report and in his verbal remarks today that he thinks at least part of the increase in case reserves is a reflective of relative reserve strengthening, not just so that at the end of 2013, for instance, for TPLBI, relatively speaking, the current case reserves are more adequate than they used to be in the past. Not just higher, but they're more adequate. One way of doing a simple cross-check on that, it's not a perfect cross-check, is to look at a different way of estimating ultimate, and I've done a separate what's called a paid loss development. I don't know, Ted didn't mention whether he has done such a thing or not. Anyway, when I do a paid loss analysis on the TPLBI, what I find is that in fact the projections of ultimate loss cost based on looking at paids only, ignoring the case reserves, come out actually higher than doing the normal incurred loss development. And other things being equal, that suggests that case reserves are not relatively stronger than they used to be. They may be higher, but they're not relatively stronger, other things being equal. Later in the presentation, Ryan will share with you the changes in claiming behavior that insurance companies are experiencing in Alberta. This table shows, similar to one presented by Ted, shows the annual future loss cost trend rates by subcoverage developed by us and by Oliver Wyman. The estimated future loss cost rates are more or less identical except for collision and comprehensive. While there is some difference in disability income, but it's such a minor coverage it doesn't matter much, whereas collision and comp do. I would like to discuss those differences in collision and comp in a little more detail. To do that, I need to go to bring up the Oliver Wyman report and focus on some graphs and tables that are in that report. And I hope I can pull this off. Okay, can we get down to page 38? Okay, on page 38, I think it is, of the report, Oliver Wyman presented these graphs of for collision of claim frequency, claim severity, and loss cost. I'm going to focus on the left-hand graph, which is the loss cost graph. The model that I fitted that leads to roughly a 0% trend rate was based on an observation looking at that data saying something seemed to happen around the end of 2006. We saw collision was drifting upwards. Then there's a big bump. It jumps up to a new level, and then it kind of waffles around up and down from that point. Okay. Yeah. So somewhere here, there was a big jump. So in the model, one of the models I fitted, I said, okay, let's suppose there was actually a change in level at this point in time, and I fitted that, and it fits. So that, in fact, the level was down here, and now it's up here at some new level. And if you have a model that has that kind of variable in it, and then put the trend, and then the trend is statistically interdependent with that level change, then you end up with a fairly flat change. You can see that in the graph. If the level goes way up, then that's fairly flat going across. I also have run models, so if we don't accept that there may be a big bump that happened around the end of 2006 and just fit a general trend, then I find that my trend, and that's what I think Oliver Wyman didn't put a change in level variable in their model as far as I know, then instead of getting 0% trend, I get a 3.1% trend, which is relatively close to the 2.5% that Oliver Wyman selected. If we can go down to the next page, there's a table. Oliver Wyman ran a whole bunch of sub-models, if you like, to fit trends based on different periods included. And I guess ultimately they took some averages. But I just focus on the first part of that table, which I think when you're going to see company filings, companies are probably going to trend through at least 2013 second half. So if we just look at the first sub-table in there, depending on what period you trend from in this thing, 2008 onwards, up to more recent times onwards, you get very different numbers. And I think one should expect, this is based on all industry data alone. Ted also had a slide where he presented looking at some trends in, I think it was Auto BI, based on the 11 largest companies, and there was a huge range there. So what I guess I'm saying to you is a single number does not capture this thing. Even if 2.5 and 3.1% are about the same, that number isn't a very good number for judging rate filings on, because look at all this. Even with all industry data, we've got a range of numbers from 1.6% to 11%. If I move on to the comprehensive coverage, and again, I want to look at a table that Oliver Wyman presented, another page or so downwards in their report. Oliver Wyman did an analysis based on full year data after factoring out the catastrophes based on the IBC report, and again fitted a number of things, and it it's selected an overall trend of 1%, but if you look at this table and you look at the time frame from 2004 to 2012, they fitted a 4.5% trend after removing the catastrophes. This is my trend at 5.5% estimate, which is much higher than their 1%, is not very different from the 4.5% there, and represents the trend from 2004 onwards, so to 2013. So the 2013 comp number is again high, and who knows if when Oliver Wyman gets the catastrophe data for 2013 and looks at that fit again, they might get something pretty close to 5% or something of that order. So we may be quite close on the long-term trend. It's just a question of what the view is on that. Okay, now I need to go back to our slides. This map shows the growth of catastrophic weather events or weather events that have produced at least 25 million insured losses in Alberta over the last 30 years. In 2013, 55% of insured losses from catastrophic weather events nationwide were in Alberta. Between 2009 and 12, 50% of those losses were in Alberta. For the comp catastrophe provision, Oliver Wyman selected 30%. The percentages, which is based on the average of persons using 15 and 20 years of data averages up to 2012 only, is low relative to the 36% provision based on the past 10 years of data and the 44% provision based on the past 5 years of data, again, both up to 2012 only in Oliver Wyman's analysis. Accident year 2013 was, by the way, I guess I should just interject, when I've done my analysis of comprehensive, I didn't actually use the IBC data and remove it. I addressed it a different way. I used a regression where I put in a regression variable that says here's the periods when there was catastrophes occurring, and the regression model actually fits the catastrophe loading at part of the time. And it turns out the catastrophe loading and the trend are interdependent. If you fit one and not the other, you get radically different results in these models. 2013 was again a high catastrophe year based on my modeling and looking at the trend using my 5.5% trend. My guess is that the cat loading will be of the order of 40 to 50% again in 2013, which is similar to the 5-year average, although that when the data comes out, we will see that for sure from IBC. It seems to us, because of the interdependence of the trend and the catastrophe loading, that best practice would argue that one should use a similar time frame for establishing both the trend and the catastrophe loading. And that's something I believe that Oliver Wyman has not done in their methodology. Their current 30% cat loading is based on a very long-term average, but their trend is based on, their 1% trend is roughly based on the last 4 or 5, 6 years with a missing point, and with 2013 missing and 2011 excluded because it was an outlier. It seems to me best practice would be either to, if you're going to keep something like a 30% long-term loading, then you should have a long-term trend as well. And that long-term trend certainly won't be 1%. It will be something very significantly higher. Or else you should use perhaps their 1% trend and then a much higher cat loading, which represents what's happened in the last 5 years or so, which probably is a 45% give or take loading. This slide shows the number of catastrophe events in Alberta between 1993 and 2012 based on the Giza Cat report. Between 2008 and 2012, there were 31 catastrophe events identified, 27 2003 to 7, 18 from 1998 to 2002, and only 14 in 1993 to 1997. It's very clear that there is a strong uptick trend upwards in the frequency of cat claims in Alberta over the last 20 years. We also examined Alberta weather data from Public Safety Canada, and the data showed that over the past 20 years, the majority of the costliest hail, thunderstorm, wind, and flood events occurred in Calgary and southern Alberta. So there is a geographic component to this problem as well. The data from the Giza Cat data and the data from the Loss Development Exhibit are all industry, total province data only. So we can only deal with the whole level of province. But it's very clear that depending for an individual company, it may have writings that concentrate in different. If they concentrate in Edmonton in the north, it's a very different situation if their writings are concentrated in Calgary and south. So one should expect, even if one can reasonably establish a provincial level as a reasonable cat loading, that loading could well vary significantly from company to company, depending on their geographic distribution of business. And that's all. So I will now turn things back to Ryan to continue.
Thanks, Ron. This graph shows the loss costs by subcoverage from 2009 to 2013. Based on these figures, only comprehensive experienced significant volatility and cost escalation. We believe that the erratic weather hitting the province was responsible for these results. For BI claims, the overall increase in loss costs has been marked, but as you can see, not dramatic. However, the underlying development patterns continue to worry insurance companies. The next series of graphs are going to be similar to the ones that Mr. Zubalek presented. This graph shows the development of loss costs for BI claims based on the annual estimates from IBC's consulting actuaries. The annual increases in the estimated loss costs illustrate the adverse development Dr. Miller and Mr. Zubalek spoke about earlier. For collisions that occurred in 2009, between the initial estimate in the 2009 reporting period and the most recent update in the 2013 reporting period, IBC's consulting actuaries adjusted the cost per vehicle of BI claims upwards by 36%. For collisions that occurred in 2010, they adjusted the cost per vehicle upwards by 42%. For collisions that occurred in 2011, they adjusted the cost per vehicle upwards by 30%. And for collisions that occurred in 2012, they adjusted the cost per vehicle upwards by 25%. To assess the degree to which the frequency and/or severity of BI claims contributed to these overall loss cost increases, we compared each factor for different reporting periods. This graph shows the development of BI claims frequency, and as you can see, overall, the estimated frequency of BI claims has not varied from reporting period to reporting period. This graph shows the development of BI claims severity. For collisions that occurred in 2009, between the 2009 and 2013 reporting periods, IBC's consulting actuaries adjusted the average cost of a BI claim upwards by 36%. For collisions that occurred in 2010, they adjusted the average cost upwards by 56%. For collisions that occurred in 2011, they adjusted the average cost upwards by 42%. And for collisions that occurred in 2012, they adjusted the average cost upwards by 27%. In effect, these results show that an increase in the average cost of a claim was solely responsible for the adverse loss development of BI claims. After conducting similar comparisons for each subcoverage, we did not find evidence of adverse loss development except for accident benefits in accident year 2012. This graph shows the development of loss costs for AB claims based on the annual estimates from GIZA. As you can see, for collisions that occurred in 2012, GIZA actuaries adjusted the cost per vehicle of AB claims upwards by 11.4%. As with the situation with BI claims, an increase in claim severity was responsible for the adverse loss development you see here. Between the 2012 and 2013 reporting periods, the frequency of AB claims remained stable, whereas GIZA's actuaries adjusted the average cost of an AB claim upwards by 11.3%. Earlier this year, we met with claims managers from several large insurance companies operating in Alberta to discuss the trends we are seeing in the industry-wide data. The companies confirmed that while the frequency of BI claims has been stable from year to year, the average cost of a BI claim has been rising. Specifically, the companies report that a greater proportion of people with minor sprains or strains are securing legal counsel earlier in the claims process and claiming to have subjective and difficult to prove impairments such as TMD, a psychological condition, a concussion, and or chronic pain, so as to pursue a pain and suffering award above the minor injury regulation amount. The companies date the onset of this trend to 2011. Also, they credit the Alberta Court of Queen's Bench decision in Sparrowhawk v. Zapoltinsky from January 2012 with empowering personal injury lawyers to pursue more often pain and suffering awards beyond the minor injury regulation amount. Going forward, they also believe that the government's recent decision or recent amendment to the Diagnostic and Treatment Protocols regulation to remove jaw pain and other conditions from a list of treatable symptoms of whiplash and transfer them to an interpretive guideline may further aggravate the AB and BI loss trends. Another issue or another cost pressure we want to bring to the board's attention is the health levy. The first graph, or the one on your left, shows that in 7 of the past 9 years, the government raised the health levy by at least $5 million. Over this period, the health levy nearly doubled from $60 million in 2005 to $105 million in 2014. Last year, the average cost of the health levy for Alberta consumers as a whole was, as Dr. Miller pointed out, $28 per vehicle. Because the health levy is applied as a percentage of premium, for the grid population, the health levy represented $70 per vehicle, as Dr. Miller already mentioned. Changes to the health levy occurred while the number of BI claims remained stable and the number of people injured or killed in motor vehicle collisions declined. The graph on your right shows the absolute number of people injured or killed in motor vehicle collisions in Alberta between 2005 and 2012. The data is from Alberta Transportation. As you can see, during this time period, the number of people injured or killed in motor vehicle collisions in Alberta declined by 25%. This trend happened despite population growth in the province of 17%. We recognize the cost pressures facing the public health system, but because the large majority of motor vehicle collisions result in minor sprains, strains, or simple fractures, we do not believe they require the type of specialized care that is probably driving the government's health system costs. As well, population growth has been an important factor to the overall cost trends you see here.
Thank you, Ryan, and thank you, Ron. We're going to conclude IBC's presentation by summarizing our 3 key points and recommendations, and I might add a 4th just based on Ted's and Oliver Wyman's presentation this morning. First, we recommend that the AIRB start adjusting the grid base premium so that it more accurately reflects the actual loss experience of the grid. Without an appropriate adjustment, the grid ceiling price, we believe, may suppress the level of price and coverage options for consumers that the government and the AIRB designed the new premiums regulation to achieve. Also, without an adjustment, the grid ceiling price will continue to place an unfair burden on the majority of Alberta consumers who will remain responsible for covering a disproportionate amount of the cost to insure the grid population. Secondly, the similarities of the estimates from the Oliver Wyman and Barron reports validate their findings. However, the differences show the importance from a rate regulation perspective of considering target ranges when adjudicating rating programs changes. Because of the different business models and strategies in the Alberta auto insurance market, we continue to advise the AIRB to use the factors only as guidance when adjudicating rating program changes. Third, the cost pressures facing BI claims are concerning. We have begun a study of the closed claims to identify the source of the pressures. In the fall, we will present the results of that closed claims study to the government. We hope the results will help the government develop legislative and/or regulatory solutions so that we can continue to maintain the stable and competitive market consumers in Alberta have come accustomed to over the last decade. And the fourth I'd like to add is in reference to Oliver Wyman's indication that they've undertaken a grid analysis. We would most welcome the opportunity to comment on that analysis once it's completed. With that, we conclude IBC's presentation. Thank you to the board for the invitation, and we'd be most pleased to entertain any questions you might have.
Thank you. Is there any questions from the staff before I... Any questions? No. Any questions along the ladies' gallery?
No. Yes. I do have one. The closed claim study that you're doing, that will be done in the fall, will that actually deal with the categories of the types of claims in the BI severity? Is that what you're looking at?
It's going to go right into BI claims, to the type of injuries, the amount paid, everything like that.
Okay, thank you.
Good vote.
On the claims, well, first of all, let me go back to the grid. On the grid situation, do you have any ideas from an IBC perspective on what the difference should be from the regular market to the grid on a premium level? Do you have any percentages that you feel might be appropriate?
I don't think that's the right way to think about it. But it should be that the grid should have rates that support itself, and the voluntary market should have rates that reflect the competition that will come with companies being able to do their own thing within reason with the filings. So I don't think there should be a pre-assessed percentage. At any given time, there will be a percentage, but the grid population changes over time, and when the grid rates change, the population changes. That those percentages will vary over time. So,
is there a danger? Do you think then if the grid is in place to provide accessible insurance to all, and so therefore, by pricing the grid too high, you're not at danger of precluding those people from purchasing insurance and therefore going under it, and therefore not carrying insurance?
Go ahead.
I think obviously if you increase the grid, there are certain drivers that are not going to be, that are going to be below it. But it all, really has to do with what the government's public policy objective is with the grid. What type of drivers it wants to catch on it, what type of drivers it doesn't. We believe that maximizing the opportunities for competition beneath the grid level will be better for consumers in general. But it's really a public policy question, I think.
And lastly, do you think there should be any subsidy at all the grid from the regular market?
We're not here to we're not here to suggest getting rid of the grid by any means. I mean, we know it's an important it's an important public policy tool for the government.
Thank you. Okay, you finish. Go ahead.
I just want to be a little bit more clear. Dr. Miller stated that the grid should support itself. Are we to infer from that you're looking at a break-even proposition for the grid ceiling, or is it IBC's position that there should be some profitability within the ceiling grid rates?
Some profitability? I'm not sure.
I'll try and ask it as simply as I can. On the ceiling grid rates, is it IBC's position that there should be that those rates as set should provide for profit?
I don't know. I can't answer for IBC on that.
I think the answer to that comes back to what the intent of the grid is. We recognize that the grid was instituted to achieve some public policy objectives. It's our view that government still has very much an interest in the grid playing that role. What we advocate is that to the degree that it is possible to find a line between an adequacy in the grid and achieving public policy objectives of the grid, that line needs to be found. We think it speaks to the broader issue of changes in the premiums reg and the elimination of the industry-wide adjustment, where, to use to Ted's comment, is that there's no average insurer. Each insurer is going to have their own experience and should be judged accordingly. We think similarly, to the degree that you can find the line between the public policy objectives and rate adequacy in the grid, that's a theoretical line that we should attempt to explore.
I guess I would add something there. The grid, as it's currently constituted and has it's behaved over the life cycle since 2004, has represented something of the order of 7 or 8% of the market. That's a very large share of the market. As long as the grid remains affecting that kind of percentage of the market, then I think the risks of if the rates on the grid on average are more adequate or are actually adequate with or without a profit provision, the risk of making things unaffordable for people is not big any more so than it has been over the last several years. You would get into that kind of situation when the grid was only capturing some very small percentage, like 1% or 0.5%, then you would have probably a real affordability issue.
Further question? Alan?
I'm not sure if this is a question or more a comment, but mention that the health levy is increasing greater than bodily injury claims, but as a hypothesis, what's IBC's view on that it could be that the health levy in the past just was inadequate to recoup the costs of past claims, and therefore it has been increasing to catch up.
That could be the reason why it's increasing, but when we just look at the numbers like you saw in the graph, the health levy's going up while the number of casualties from collisions are going down. We also think that the nature of auto insurance collisions, those being pretty minor, don't require a lot of the type of care that's probably driving those costs. And we wanted to use this as an opportunity. We're talking about just cost trends and that type of thing to highlight the health levy, because it's just on a cost per car basis, it's up there with some of the sub coverages.
I'd also add to that, if I could, that we know that the health levy is, in addition to being an important issue for the industry, we know it's an important issue for government. The insurance industry has no qualms whatsoever with paying its fair share of the burden that it imposes on the healthcare system. what that burden is, I guess, is the question, and it's a question that we know government has. So we are in discussions with the Department of Health about undertaking an analysis and a report that would be produced that would summarize what is the burden that the P&C insurance industry places on the healthcare system, and what is the appropriate healthcare levy that should be imposed. And so we welcome advancing those discussions with the government and coming to something that's very much equitable and reflective on the reality of the costs.
My recollection is when the health levy was established, the principle on which it was established was before the health levy was there was case-by-case subrogation going on under third-party liability bodily injury coverage, so that when somebody else was responsible for someone's injury, then a recovery was made to the extent that the policy limits allowed it. So the health levy as theorized or as introduced never was intended to cover all costs arising out of automobile insurance accidents, but only those where there was in fact a third party that was responsible for them. And to replace it, the subrogation was replaced by the levy, and that was similar to what was done in other provinces around the country.
Yeah, if I could ask Ryan to expand on the comments regarding jaw pain and the DTPR amendments recently.
I think we covered this in a letter that we had sent, not directly to you, but to your office. So in the DTPR, they're part of within. I can't remember the section by heart. It might be actually section 17 and 21, but it was under for whiplash, talking about educating for the treatment provider to be educating the injured person about some of the other symptoms that they would have, and it listed some of them. Some of the ones the health provider should focus on when they're educating and talking about pain management, that type of thing. One of them was jaw pain in both of those sections. And when the government was cleaning up or updating the diagnostic and treatment protocols, it removed the list of treatable symptoms, and I believe the intention is to put them into an interpretive guideline. And I know there have been discussions where we thought, it's always good if that's explicitly in the regulation, and then we were also told, well, if you put it over here, it really it might not make a difference. But it was something that our member companies really zeroed in on, particularly the jaw pain one. There was other symptoms, but particularly that one because of what they're seeing in the claims environment.
And then the other question I have is related to the closed claims study. And Bill, you had made mention that the hope is that will be presented to government and lead to some form of legislative or regulatory reform. What does industry plan to do with the results?
Our intent is to, as it is in always these kinds of reports, is to populate the dialogue that we have with regulators and with government with good information that can shine a spotlight into areas where there is a lot of subjectivity, a lot of anecdotal information, I think, has been referenced to this point. So we would hope that it would be used to consider whether or not the findings pointed to any undesired shift in the insurance environment that would run counter to government's objectives. It would also likely be used by industry to again better articulate the extent of the problem that anecdotally all of our members are sharing with us. So the intent overall is just to really provide to quantify what anecdotally is clearly evident that's taking place.
Thank you.
Thank you. Thank you, gentlemen. We appreciate your presentation, and certainly we'll take it under consideration, and you'll hear from us, I'm sure.
Great. Thank you.
Thank you. Now, the next presenter is the Facilities Association, and they've been here before, by golly. Anybody else warm, or is it just me? I hate those lights. They shine down here. Gentlemen, you're on, and then introduce. I don't know whether we need introductions, but go ahead.
Thank you, Mr. Chairman. It is a pleasure to be with you again this year at the new open meeting in the new context. My name is David Simpson. I'm the President and CEO of Facility Association. With me today is Sean Doherty, our Senior Vice President Actuarial, and our Chief Financial Officer. Sean is a fellow of the Canadian Institute of Actuaries and a fellow of the Casualty Actuarial Society. We are here today primarily, as before, to provide an update on the Alberta risk-sharing pools, their size and financial performance, and potential implications for rate setting. Our presentation this morning is essentially an annual update to the presentation you've seen in prior years in the context of the former industry-wide adjustment hearings. And as always, we're trying to be relatively brief to make sure there's time for questions the board might have and ongoing dialogue. One thing that is new this year since the last time we met with this board is that with the support of our board of directors, we adopted mission and vision statements for Facility Association in the first time in our history. And they're on the slide there. I don't think I'm going to read it word for word, but as the slide indicates, we always want residual markets to be as small as possible so the consumer benefits from the competitive marketplace to the greatest extent possible. And in our vision statement, we also say that we want to be people who can be seen to provide objective opinions on residual markets and related matters to all interested parties. In Alberta, we operate two distinct types of residual markets. The residual market segment is for owners and operators of vehicles who are legally authorized to be on the road but unable to obtain insurance from an individual insurance company. Vehicle types insured through the residual market segment span everything from motorcycles and snowmobiles right through a few private passenger cars, and right on up to sand and gravel and logging trucks. So pretty much everything that requires insurance is eligible to be insured through the residual market segment. The other type of mechanism we operate are the risk-sharing pools, and those are for private passenger vehicles, cars, minivans, light trucks only. Residual market segment risks are written at rates approved by the board for the segment. All intermediaries have access to the residual market segment, and most importantly, the consumer will always be charged the same rates for the same risk regardless of which intermediary they choose to do business with. The rates and rules manual for the residual market segment is available on the public section of our website. On the other hand, risk-sharing pool risks are written at individual company rates as approved by the board, and then transferred to the pool behind the scenes by the insurance company. The risk-sharing pools are therefore invisible to the consumer. The balances of both the residual market segment and the risk-sharing pools stay within Alberta and are shared by Alberta automobile insurers on a market share basis, broadly speaking. And if you're a licensed automobile insurance company in Alberta, for those who are not aware, you're required by law to be a member of Facility Association and participate in the association. And insurers do participate, broadly speaking, by market share, and that sharing is further refined by line of business and by accident year. And when I talk about sharing, I'll use the word balances and amounts rather than results, because we don't share just the bottom line results of our business. We share all the lines, including premiums, for example. And companies take those premium balances that we share with them, and they must pay premium taxes, health levies we've heard about this morning, just on the same basis they would if they'd received that premium through their own intermediaries, for example, through their own business efforts. There's no distinction financially. Our operations are governed by our plan of operation as authorized by the Superintendent of Insurance for Alberta. The plan and other information about us is available at our website, facilityassociation.com. We welcome any questions from the board and other stakeholders about our operations at any time, and are, of course, always willing to meet with the board outside of the formal hearing context to the extent that would be helpful. Before I go into detail and a little bit more of the detailed annual update about the size of and performance of the risk-sharing pools, I'd like to note that in a general way, smaller residual market mechanisms are correlated with a degree of price competition that's allowed in the marketplace. And because of that, we believe that the recent move to an individual company-based file and approve system of rate regulation here in Alberta has the potential to result in smaller residual market mechanisms. We view that as very, very positive and completely aligned with our mission. A little bit of background on detail on how risk-sharing pools operate and why they came to be. Risk-sharing pools are typically an industry response to an industry-wide requirement that individual companies must accept business that they believe to be inadequately priced. They act as an industry-wide reinsurance mechanism that allow companies to mitigate the risk of having to accept that underpriced business. In Alberta, there are 2 risk-sharing pools created by the industry that we administer. One to accommodate the policies subject to the maximum allowable premium under the premium grid regulation, simply known as the grid pool. And another to accommodate business that companies must accept under the take-all-comers regulatory provisions in the province, perhaps inelegantly known as the non-grid pool. All business transferred to both pools is written at company rates, as I mentioned, and both pools are strictly for private passenger vehicles only. There are limits to what companies can transfer to the risk-sharing pools. For the grid pool, all grid risks are eligible, so there's not a mathematical limit as such in the calculation of formula of the number of risks that can be transferred to the grid pool, but there is an implied limit by the number of risks that are subject to the grid in the marketplace. As we've seen over the years, the actual number of risks transferred to the grid pool has declined over time, and presumably that's because companies have taken a different view over time of the adequacy of the grid rates. So from a practical standpoint, the actual number of risks transferred to the grid pool is somewhat less than the grid-rated risks out there in the marketplace. For the non-grid pool, there is a mathematical limit. Companies can transfer 4% of the total number of written exposures they have not transferred to the grid pool. So getting into the specifics and update and the size of the pools. On a written premium basis, the total market share of both risk-sharing pools declined from 9.1% in 2012 to 7.7% in 2013. And if you look going back there through 2009, the market share of the non-grid RSP has been relatively stable, moving up and down around 3%. But we do see a distinct decline on a year-by-year basis in the grid pool. From a written exposure standpoint, written exposure, one car insured for 1 year, the total market share of the 2 risk-sharing pools in 2013 was 4.9%, down from 5.7% in 2012. And as this slide shows, exposure counts declined in both the grid pool and the non-grid pool. At the member company group level, more than 2/3 decreased their transfers to the grid pool, while more than half of non-grid pool users increased their transfers. And I just want to piggyback on a theme that Mr. Zubalek introduced in his presentation, in that we all tend to fall in the habit of talking about the industry as kind of a shorthand and think of the industry sometimes in monolithic terms. And he showed the various loss ratios different companies were experiencing. I really like this slide because it shows at any given point in time, companies are viewing their business, what their current book of business is, the business they're taking on, at a different way, and they're interacting with the risk-sharing pools, both the grid pool and the non-grid pool, in a different way. And again, I think that ties very nicely into the new regulatory framework here in the province. At any point in time, companies are viewing their business and their marketplace in a different way from one another. Even though the total market share of the Alberta risk-sharing pools has declined, and we view that as being positive, on a written exposure market share basis, Alberta continues to have the 4th largest residual market for private passenger automobile insurance in North America. This slide highlights the loss ratios through time, and it's similar in format to the slides from Mr. Zubalake and Dr. Miller. And as has been noted by ourselves and many others, of course, our business is the business of estimates, and we've seen how those estimates can and do change over time. And each year, our consulting valuation actuary, and that's Liam McFarlane at E&Y since last year, provides us with an estimate of the ultimate loss ratio for each accident year. This slide shows how those estimates have changed over time. The estimates associated with the first estimate for any given year, as we've seen with other exhibits for the industry, tend to be the most volatile, as the composition of the loss ratio is weighted more heavily to unpaid claims. We've included the Alberta Grid Pool's loss ratios from the previous slide on the chart here, and also included the earlier accident years for the pool, and it gives you a sense of how the loss ratios are built up, if you will, in a similar manner to used by Mr. Zubalake. On this chart, the paid losses are indicated in blue, case reserves of the individual companies are in red, and IBNR, the actuarial provision, is indicated in green. And as you might expect, the IBNR provision, the case provision, are typically larger in the more recent years before claims have been settled. For the grid pool, as indicated, the loss ratios have fluctuated between roughly 60 and 70% through time. And I'd like to note that this is a snapshot at a point in time to line up with our financial statements. So that's October 31st of 2013. We do Sean and his team update these charts monthly, and they are posted to our website as part of our bulletin process. So the latest update is always available, and again, on the public portion of our website. In contrast to the grid pool, the non-grid pool's loss ratios have both been generally at a higher level, between 85 and 105% roughly, and have been more volatile through time than what we've seen in the grid pool. In terms of financial performance, as shown in our audited financial statements, the grid pool is showing an accumulated surplus of approximately $102 million since inception in 2005. It's actually 13 months. We started in the last month of our 2004 fiscal year. And the non-grid pool is showing an accumulated deficit of $185 million for a combined deficit of $83 million. And as we have shared previously with the board, those are the results of our audited statements. But when it comes to member company impacts, it is important to note that while our financial statements are prepared according to general accepted accounting principles, because of that fact, we can only show what happens within our operations, within our walls. So as our member companies book the balances into their statements that I mentioned earlier, they therefore have to take those numbers and account for health levies, premium taxes, income taxes, cost of capital, and the investment income on the policyholder supplied funds as well. Alberta automobile insurers, through their compulsory participation in the risk-sharing pools, cannot escape the fact that it's a smaller percentage, but still 7.7% of their book of business as an industry is behaving in a way that's largely beyond their control. Because of that, there's always a risk that insurers may view the Alberta marketplace differently than they do markets where they have more control over their own pricing. And in particular, I think there's a heightened risk here for perhaps the smaller market players, in the sense that they might not have the deep pockets that some of the larger national and multinational companies have to absorb impacts that they have to take on from the compulsory participation in the risk-sharing pools. I'm pleased to say that we don't think we've seen material adverse impacts on company behavior because of the risk-sharing pools or residual markets here in Alberta, but I do feel duty-bound to point out the fact that the risk is there and it remains to be there. Another risk is that risk-sharing pools are not financially self-sufficient. In a general way, of course, companies will transfer business to the risk-sharing pools because they believe it to be inadequately priced. And that means that to get their level of return that they're targeting, they have to get the rate from somewhere. They have to get it from other consumers, presumably. So And we recognize, as IBC touched on, there are public policy objectives to be achieved with the grid mechanism in Alberta and with the risk-sharing pools to support them. But there is the potential and the actuality of some ongoing cross-subsidization from other consumers, and we recognize that reality. And it's also important to note that risk-sharing pools will impact companies in different ways, because companies will make individual business decisions on what they choose to transfer to the risk-sharing pool, and they will have to take back the results of what they get from the risk-sharing pool. And it does seem to us that some companies are perhaps a little bit more adept at playing the game, if you will, and they will submit business that performs worse than the pool as a whole. So in general, they might come out a little bit of a winner, relatively speaking, and other companies less adept. And so, and again, it's to say that the risk-sharing pools have different impacts on different companies, and as the board is looking at those individual rate filings in the new framework, we would encourage the board to take a look at each company's results and just remind the board that companies will have different results relative to the pool, one from another. Preferred outcomes, consistent with our mission, we always want the risk-sharing pools to be as small as possible. They can be a very effective residual market mechanism. They do seem to be doing their job here in Alberta, given the public policy objectives and the dynamics and the framework of the Alberta marketplace. However, because they do pose that financial risk I mentioned earlier to companies, we think if we keep them as small as possible, if we see some volatility in percentage terms, as long as the dollars are small, the individual company impacts won't be that great. And ultimately, our goal with whatever type of residual market mechanism that we're administering on behalf of our industry, we don't want companies coming to the competitive marketplace and saying, I've got to adjust my risk appetite and downward particularly, because I'm afraid of what I might have to take on from the residual market. And I don't think that's a place that any of us want to be. And we continue to encourage industry and regulators to look at the population that's eligible for the grid to make sure that from a public policy perspective, that population is the appropriate one. And we're agnostic about that, but we continue to encourage that review with the goal of keeping the residual markets as small as possible. And we also encourage market adequate rates. And we believe that the current file and approve system, moving away from the one-size-fits-all approach of the industry-wide adjustment, provides greater scope for adequate rates across the marketplace under the leadership of this board. Mr. Chairman, that concludes my formal remarks. We'd be pleased to take any questions.
Thank you very much. Any from the staff? Yes, Ted.
Just a couple of quick, somewhat technical questions. Each of the three presenters this morning presented some loss ratios tied to the grid. And Dr. Miller explained some of the differences between his loss ratios and our loss ratios that I presented. Your numbers are also different. What's in the loss ratios that you present on that slide there? What's included in the loss? Is the health levy, for example, included, or are these pure losses? Is allocated loss adjustment expenses? We just want to try to understand the differences.
Certainly. So the first important caveat is this is only business that has been transferred to the risk-sharing pool. And so over time, as we've shown, that has changed. The second piece is that the main component of this is for indemnity, the indemnity portion of the claims amount. There is a small component that is what we refer to as allowed claims adjustment expenses. But the majority of the claims adjustment expense that members who are transferring claims into the risk-sharing pool or policies into the risk-sharing pool will capture their ULE, the unallocated loss adjustment expense, and a large portion of the allocated loss adjustment expenses that they would incur, they capture that through an expense provision that we update every year. It gets approved by our board and approved by the superintendent's office, and we work with Oliver Wyman on producing that exhibit. So what we have here is, for the most part, just indemnity.
And thank you. And you I think answered my second question, which was I didn't understand what was in your written submission, what specifically allowed expenses are. And so there are small proportion ALE type?
That's right. It's laid out in our plan of operation. Some examples would be if you have a specific amount for legal expense that's tied specifically to a claim, we would allow that. There are some actuarial, some medical type things. But those are professional fees that are explicitly laid out in our plan of operation that we allow member companies to recoup through this process. It is audited through our internal audit as a regular part of our audit process.
Okay.
And I'm sorry not to interrupt, but that schedule of allowed expenses is available on our website as well for anybody that wants to dig into the detail.
Okay, thank you. And last question, which you may not be able to answer without the report in front of you, but it's an issue that's come up with the work that Dr. Miller did and we have done with respect to the grid. And that is, do you know if, I guess, your EY consulting actuary in providing or estimating the ultimate cost, whether or not these loss ratios, he or EY is using development patterns based on your experience only, or are you looking at total? Does he look at total industry-wide development patterns?
For which particular?
For developing these loss ratios that we see on this chart here.
Okay, so for the individual grid, say for the grid risk-sharing pool,
yes.
We will look at the experience of the grid pool. To the extent that they believe there's not enough experience, the pools only started in 2004, they may augment with development factors that are selected based on the industry for individual coverages.
Okay.
Similarly with the non-grid pool, the industry results that you see here, I would just emphasize that these are indemnity only.
Yes.
These are our view. Even though we do use the same consulting firm as Giza,
yes.
we may not have the exact same loss development factors because there's a different process that we go through.
Gotcha.
I would just add to that, if I could, that one of the luxuries that we have of being an industry association is we have access to a lot of company expertise. And we do have an actuarial committee of senior actuaries from member companies. I think the membership is about 10 or 12. And they meet 8 to 10 times a year to look at and provide input into the experience and feedback from what they're seeing at their individual companies to help Sean and Liam McFarlane at EY with their insights. But ultimately, of course, it's the appointed actuary who holds the pen on the final number, if you will. But there's a lot of thought process that goes into the work that Sean and his team are doing.
Okay. And one final question, just a clarification. Geez, I lost the train of thought here. It'll come back to me. Yes, the grid. These loss ratios that you show here. We've been talking about the grid and how the grid only applies to basic coverage, but these loss ratios here are for and I'm talking about the grid RSP loss ratios that include the optional or additional coverages as well.
That's correct. At the current
when the risk
time,
is ceded to the risk sharing, the grid risk sharing pool, you get the entire risk is ceded as the physical damage coverage as well as the basic coverages.
At the current time, for both pools, companies are required to transfer all the coverages for risk to the pool if they are transferring the risk. Yes.
Okay. Thank you. All right.
Thank you, Ted. Mark, do you have a question?
Not at this time.
No. Okay. Alan?
I got a question. Do you have any idea how much of the grid-rated premiums as a percentage of the total is being retained by Alberta insurance companies?
if I recall correctly, and it can be shown quickly in the pamphlets over here, I believe that 7.7% of the market is currently grid rated. And as we showed in our results here, the grid in 2013 represented 2.2 as we calculated. So approximately 5.5% of the marketplace has grid rates that aren't currently moved to the pool. So it looks like we're about a third. The risk sharing pool right now has got about a third of all grid rates. I could be wrong on that, though.
Thank you.
Anything else?
I have a question.
No, I'm just going around.
Okay.
Go ahead, you're next. Good.
In relation to your slide, it's on slide 14, the top 6 private passenger residual markets in North America. First question, does every market have a residual market? Let's deal with Canada.
Certainly for the private enterprise competitive markets, there's a residual market. Where automobile insurance in Canada is provided through a government monopoly, there's no need for residual market, presumably, because there's nobody left over that doesn't, it's a take all comers market by definition. So there are no risk sharing or no residual markets in British Columbia, Saskatchewan, Manitoba. There is a risk sharing pool in Quebec. We do not administer that risk sharing pool. We administer risk sharing pools in 6 provinces in the 3 northern territories.
Right. And so, with the advent of file and approve, where do you anticipate, and where would you like to see the Alberta position in percentage-wise?
Our mission statement is carefully worded to say as small as possible, and we recognize that will depend on market conditions in a given marketplace. So we don't have a numerical target in mind. In jurisdictions, though, with risk-sharing pools, Ontario now, the residual market is
0.00%.
That's the residual market segment. You have to take it to the second decimal place on a percentage. Nova Scotia has a risk-sharing pool for inexperienced drivers with clean records. That's typically around 2% on an exposure count basis of the market. The residual market segment there is less than 1%. So that's something when we're looking at that. Again, we see that as a healthy market in the context when the residual market volumes are that small. And again, no company should be looking at that and saying, I'm afraid to step into that marketplace or increase my presence, my offering to the consumer, because I'm afraid because of my compulsory participation I'm going to bring back balances from the residual market mechanisms.
And do you still see Alberta as a what's the word I'm looking for, a attractive market and a viable market for the automobile insurers?
Respectfully, I don't think that's for me to see. I think that's really for the marketplace to decide and for the insurers to decide. But there does seem to be a degree of stability in the marketplace, and large, good quality companies and some very active and nimble smaller players in the marketplace here too. So we don't see a marketplace that is anywhere near a crisis, for example, if you were to ask us. But we do see a marketplace where we think that as the regulatory framework changes would seem to reflect, that there's an opportunity for greater competition to the benefit of the consumer.
Great. Thank you.
Question, Merrill?
I don't know if I even want to go here. I was trying to figure out your numbers, Dave, every year, and I never do very well. But
that's why Sean's here.
You can't figure them out either.
But we have talked about the grid and the need for reviewing the rates on the grid. And so then I'm looking at your slides 11, 12, and then 14, which has got your relative to other jurisdictions. And I find different numbers on each one, the heading explains it to some extent. So on number 11 is 7.7, which is based on written premium, and then in number 12, 4.9% on a written exposure, and then we've got 5.1 on slide 14. So if you could just sort of give me a sense, if we're trying to look for a benchmark or a guideline as to what percentage should be on the grid, which of these is the relevant number or the basis on which we would...
Sure, let me take a crack at it, and then Dave can correct me. The first one they show is on a written premium basis, and as you might expect, because of the grid system, what goes into the grid has a higher average written premium than the non-grid. And that's why you'll see here the grid ratio is at a higher level of percentage of market share than you see on the second one. We do it on a count basis. This is about half the size. And that's because if you think about it on an average written premium basis, the grid average written premium is about twice the size as the industry. You don't see the same level of difference on the non-grid, although there is some. So again, what's reflected in the non-grid is these are risks that the individual insurance companies have identified themselves using their own rates they don't feel are generating the return that they want, and so they will transfer those in. It, too, seems to have a higher average rate than the industry in total, so there may be some sort of subset. It very much depends on the individual companies. And as we tried to show on this one, even within 1 year, there's a significant difference in who's participating and their level of participation. This represents one member company group. There may be more than one company in there, but within the one company group, they've reduced their transfers into the non-grid pool by 1,500. 1,500. Well, you've had another one on the other extreme that has increased their participation in the pool by almost the same number. And so what we watch this to look for trends. And in this case, what we're looking at for the non-grid is a bit disconcerting that more are transferring more in. But when you look at the total number of how many are being transferred out versus transferred in from one year to the next, that's why you see a total decline that's happening in here on the non-grid. You get a different situation on the grid side when we're looking at this. There's more company groups as a total looking at 2013 relative to what they shared what they sent to the pools in 2012 that are declining. Now, there are some individual companies that are representing more of that. You've got a whole bunch in here that you can't see anything really because they haven't really shared or changed their actual position within the market share. Now, there's a difference between this 5.1 here and the 4.9 here, and it's because we're looking at slightly two different periods of time, and I recognize that's a bit confusing.
And also, pardon me, the 5.1 does include the small amount of private passenger vehicles that's insured through the residual market segment that has very, very tight eligibility rules. So 0.2% of a percent, I think, would be about it.
Just a follow-up question on 13, slide 13. Any way of knowing on the non-grid side how many, if there's any drivers that, like one insurance company, maybe they're insured, switch to another insurance company, and both insurance companies are taking the view that they should cede that to the non-grid pool?
That could certainly be happening. There's a lot of stuff that's happening underneath that we can't see. We're just seeing, really, all we look at are the counts that individual member companies have provided. But you're absolutely right. It may be that the reason Company A has decreased is because that one risk that they transferred went to Company B, and Company B also sees it as not being adequately priced, and they've sent that same risk to the pool. So there could be something else happening within the makeup of the pools itself, that even though the counts are down by 1,300, it could be that they're the exact same set of policyholders that they were in 2013, except for those ones that transferred out, or it could be a completely different set of policyholders. We're not, we don't look at it at that level of detail.
But if I may, on this theme, we have a very disciplined enterprise risk management framework, and so at a high level, we look at the market share of the residual markets in all the jurisdictions we serve. But then at this level, what we're seeing here we think reflects the activity you might expect in a competitive marketplace where companies are rising and falling against each other all the time. And that's not, of course, limited to insurance. That's a nature of competitive markets. If we did, however, start to see kind of everybody shift over and all the companies increasing their transfers, then we'd be likely talking to our industry partners, you people here in the regulatory community, and saying, we think we're seeing something here that we should all pay attention to and try and understand. Because if we saw all the companies behaving in one way and increasing their transfers, then in our risk matrix, that is something that we would heighten our monitoring on, that's for sure.
I'd imagine for the grid pool, and again, I have no facts on this, but the people that are on the grid, there's probably a greater propensity for them to shop around and change insurance companies, given the pricing that they're subjected to, given their experience rating.
You would think, but I go back to the commercials that were on recently where it seems that people spend more time picking an air freshener than they spend shopping for insurance. So,
on average, perhaps. But again, that's a question.
But in any commercial, more seriously perhaps, in any commercial transaction, pricing is a very, very important piece of information, and people do respond to it. And I think at the higher end of the market, you're likely to see more movement than people paying an average street premium, for example.
We had a question over here.
Thanks, David and Sean. Just a couple of questions to sort of understand the grid a little bit better, because we're getting, reports asking us to increase the grid premium level. Looking at the grid pool versus the non-grid pool, I mean, historically it's performed quite well, and last year there was $14 million in non-grid losses and all of the rest of it, 38 million, came from the non-grid. So increasing the grid rates will not impact the 75% of the book that is performing the worst. Is that correct?
That is correct. Let me just think about that just for a second. If you increase the grid rates, individual companies, then some of the business that would have hit the grid potentially now doesn't hit the grid. So if I've got a premium that is 1 or 2% higher than what the grid is, you increase the grid by 5%. Suddenly now my premium holds. I may still think that rate is inadequate, and I may now, that same risk may be moving from the grid pool into the non-grid pool. But as you point out, the loss ratios are significantly different between those two.
Right.
If I can get to them.
Okay. Another question. You talk a little bit about the subsidy that each consumer is currently paying for, let's say, that $14 million grid loss. Do you have any idea what that equates to on a per vehicle basis? What are across the industry?
Again, this part here is only our financial results. So you'd have to take that $14 million, you have to put in additional costs associated with the premium taxes and stuff like that. Then it's a simple matter of dividing that loss by the number of risks, less the risks that are currently in these pools, or you can look at it from the total grid. Again, where we are right now, I believe, is probably only about a third of the grid risks are in the risk-sharing pool. So I believe, Ted, you were going to do an analysis on the grid?
Yeah. But on the $14 million, I realize you need to load it up for expenses. But we have 2.5 million cars in the province. We're talking about maybe with $10 a car or something. I mean, orders of magnitude, just to address that $14 million shortfall.
Yeah, certainly. I think that personally, when I first joined the Facility Association in 2010, these levels haven't really changed all that much. It's certainly on this one, it seemed to me that the risks that were transferred to the grid pool performed financially a lot stronger than what I would have anticipated, and certainly I think that's also being reflected then in the market share that I can find that one.
So I guess, overall, I guess it's up to us to decide if $10 a car is an unfair burden, as we've, heard the terminology used.
Again, we're in the realm of public policy, and we'll leave that to others. We're here to
again, just to continue to understand that pool, how much of that loss in the grid is due to basic versus the additional? Do you know? Do you have any?
I could get that information for you. I don't have it at my fingertips.
Just because, right now we've always just sort of looked at one side. Now we're sort of looking at both, so it would probably be a good number for us to have.
Absolutely. When we complete our evaluation, we present the results in 3 different, we call government lines. We call them government lines because they typically are the ones that get reported into the financial statements. Third-party liability, the accident benefits component, and then all other coverages. And I think that lines in with your basic coverage being the first 2 and then the others. We can certainly share that. Okay. I'm happy to send it to you, Ted, if you'd like to have that.
I'll go with one last question to steal Ted's statement. Do you have any data on, is there any geographical area of the province that's a disproportionate share of the poor results of the grid pool? We've heard more cats down in southern Alberta. Does northern Alberta or southern Alberta have poor performance on grid rates, on the grid pool?
Or even the Edmonton-Calgary issue. Years ago, the rates had to be forced to be the same on the grid.
But Edmonton had been performing worse.
Let me just... I can't answer that directly, but one of the things that I would point out, there was a hailstorm that happened in 2010. And if you look at the grid pool, the loss ratio we have here is about 61%. And you look at the industry, it's about 61%. So I think the pool itself is probably distributed more, the grid pool is probably distributed more like the industry. We didn't see the same sort of change that happened in the non-grid. So I think there may be differences in rate that are being more reflected in the non-grid rather than the grid, but I don't know for sure. Dave asked me 3 years ago, I believe, to start looking at the territorial piece within the grid. It's on the list of things to do, but it hasn't percolated up to the top yet. Maybe it will get there.
Perhaps you could assist me in reprioritizing some of
There we
Sean's
go. Sure. Okay, thank
That's
you.
your questions answered?
Yes, thank you.
Thank you very much, gentlemen. We appreciate you being here, and it's good to see you for another year.
Thank you, Mr. Chairman. Likewise. Thank you.
At least once you come to our board once during the year or two. I'm sorry.
We're looking forward to it. Thank you. 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 Looking forward to it. Thank you.
Our next presentator is Merle Taylor. As I've explained every year, Merle is a member of the board, and she is also our consumer representative. She has to juggle those two positions quite often, and she does it quite well. Merle is making her 9th or 10th presentation today. She and I are both reached our end of our sunset clause, and this will be, both of us will be our last session, we think, unless the government dear knows what's happening over there. But we have reached the sunset clause, and Burl and I this will be our last meeting, I think. So, Burl, you're on.
Yeah, I said, because I said that last year, I thought that was my last presentation, but I said this is a bit like Cher's farewell tour. I think she did her 4th one this year, so I won't bother saying this is my last one because their new appointments haven't gone through yet.
I wouldn't tell you we're running off together if Mr. Taylor wouldn't like it.
I just click which, the advanced one. That one, okay. So there's some similarities in my presentation this year to previous years, but for some of you, you haven't necessarily seen my prior year's presentation, so I'll go through it the same as I always do. Just a minute. There we go. In representing consumers, I have to think, well, what do consumers actually care about in terms of auto insurance premiums? And the first one is affordability, obvious. How high are their premiums? Are they able to afford it as a percentage of their household budget? And I think an important part of that is to make sure that the premiums aren't so high that people simply won't pay them and they'll drive without insurance, because that's an issue for public policy. It's protection of everyone if everybody carries insurance. And so affordability is an important criteria for what consumers expect and whether they're good drivers or they're not good drivers. Rate stability. Most people have got a predictable income for the year, and if they see a spike in any of their expenses, that always makes it hard to manage. And, if you think, well, if you only have one vehicle, that's not such a huge percentage of your income to pay, or whatever it is, $1,000, $1,200 a year for your insurance. But, when I talk to people that have got 3 teenage kids and they're on a farm, and so they've got multiple vehicles, there are some people out there that are insuring 5, 6 vehicles, and so if you see a spike in insurance rates, that can make a big difference to their whole budget planning. So rate stability is important to the consumer. Availability, and this ties into affordability, and something that I think some of the questions on as to when we look at the grid we need to evaluate. Even drivers with a poor record need to be able to get insurance, and that's part of the issue in why the government is involved in regulating insurance rates. So in terms of answering those questions and trying to assess what consumers think, it can't just be what I think or what other members of the board think. And so annually I've been doing first a telephone survey, which is contracted out. I obviously don't personally do the telephone survey. And part of that, so we contact 800 Albertans through the telephone survey, and we supplemented that a few years ago with a web survey to try to contact that group that no longer has landlines, and which to some extent tend to be the younger drivers, younger consumers. In talking to the survey firm about that, because that's an increasing concern as people are dropping their landline and are using their cell phones. But the feedback is that in many cases the younger drivers are not actually paying their insurance. That until they're out of school and earning an income, in many cases it's the parents that are paying the insurance. So the telephone survey for this particular purpose is probably more valid than some other surveys that you might do. In addition to doing the survey, which is done by the firm, they select focus groups for Edmonton and Calgary. And so this year, Chris Daniel joined me, another member of the board, and it was very helpful because Chris has got a long experience in the insurance industry, and so supplemented my approach with some industry knowledge. So it was we found that very valuable. And to make sure that we weren't hitting just the urban areas, between Chris and I, we split up a list of individuals that were in rural areas outside of Edmonton, Calgary, and we did personal telephone interviews with those individuals. And I get the odd consumer that, they aren't odd, but occasional. Some of them are odd. They'll phone the rate board office. They have a concern, and those get handed off to me, and so I'll chat to them, and that comes at any time during the year. And so in addition to doing that survey of consumers, I also go to other information sources. I talk to the insurance brokers because they're really the front line in terms of dealing with the consumers, and I always find that they give me very valuable advice and informed advice too. When you're talking to consumers, you're hearing one person's point of view with what they perceive to be their policy, what they perceive to be their premium, whereas insurance brokers are dealing with a group of people every day of the week, and they can kind of filter what are the real issues compared to what are the perceived issues. Also talk to the superintendent of insurance, because certainly a lot of people that have got issues with insurance, their first line is to call Mark's office rather than to phone the rate board office, and so talk to the staff there as to what kind of feedback they're getting from the people that they're talking to on a day-to-day basis. And as you can expect with both the insurance brokers and the superintendent of insurance, the issue this year and last year has been property insurance. Auto insurance is just not as significant an issue for the consumers. It's more about what's happened with property, and no surprise given what's happened in Alberta. I also keep in touch with Alberta Transportation Safety Services, and actually when we construct this survey, because we know we do it on an annual basis, we invite both the superintendent's office and the Transportation Safety Services to identify any questions that they may have that they would benefit from getting some feedback from consumers, because once we've got the whole thing set up, we might as well include some other questions. And so in our survey, we do have a couple from Transportation Safety Services that I'll talk about in a minute. And I also have data in the report, which I derive from GISA, ICBC, SGI. And some of these questions we ask every year, and the idea of that is that you get a longitudinal look at what's happening, are things changing. And a regular question that we ask is, are premiums reasonable? How do you feel your premium is compared to what your other household budget items are? And this year, 57% of the consumers surveyed agreed that premiums are fair and reasonable. That compares to 55% in 2013, so no real significant change there. In 2005, of course, that was when we had a lot of issues in insurance. That was 46%. So you can see that over the years with the reductions in the basic premium, and that there's an increased satisfaction that consumers have got from feeling that what they're paying is reasonable. Consistent message is that, everybody that the good drivers feel that they pay too much, and the difference in premiums between good drivers and poor drivers is not large enough. Now, whether I agree with that is another issue, but that's certainly the feedback that I get on a routine basis. In talking to the superintendent's office, there hasn't been any particular increase in calls about auto insurance. As I say, the calls have been much more focused on property over the last year. And many of the calls that the superintendent's office get, the feedback that I get is that they may just be looking for information. It's not necessarily a complaint or an issue. It's just, how do I go about sorting this particular problem out? If we look at what's happened to premiums, they've increased from 2012 to 2013 by 2.4%. And, if you look historically what's happened, we have seen reductions in basic insurance. They've decreased since 2005 by now 9%. Now, those numbers are going down because, of course, we've had some increases in the last few years. But over that same period, the premiums for additional or optional coverage have increased by 39%. So there's been a shift in terms of basic and additional insurance. And I think that if you look at the loss cost on the basic and additional, there has been the additional has been more profitable than the basic. And what we've seen in the individual applications that have come in this year, that there's some rebalancing that's happening between the premiums on the additional insurance and the basic. And so those loss costs are just becoming more in line. And if you look at overall premiums since 2005, they've increased by less than 1% a year. So the increases have not been that significant overall. Availability, as I said, that's an important criteria for consumers. And certainly in talking to consumers, there's fewer than 1%. One of the standard question that we ask, and the entire survey is appended to my report if you want to plow through that or refer it to your staff to plow through. But you'll see consistently that there's fewer than 1% say that they had any difficulty getting insurance. And I think that typically if you ever talk to those people that had problems, it's not with their private passenger vehicle that they had problems getting insurance. It's some different kind of vehicle, recreation vehicle or something like that, where they had some difficulty. And they did ultimately get insurance. It's just that they weren't always able to stick with the insurer that they had. So my conclusion is that it's available. It's readily available. People can get insurance. Another sort of measure that I've been using for whether insurance is available is if people can't get it. In Alberta, there's a lot of people that need a vehicle. We're a resource-based economy. There aren't any buses running out in northern Alberta to get to the job site. So people are going to drive, whether they've got insurance or not, and that's a reality. However, the convictions for driving without insurance have consistently gone down since 2008-9. You can see the way that chart is just every year going down from the year before. So this year, again, it's down by another 3%. So that's a good news story, I think, that overall the situation of people driving without insurance is not rampant. It's not increasing. By the same token, and this is just anecdotal to some extent, but if you look at the very highest grid steps, there are a few drivers, and we're not talking about thousands here, but there are some hundreds of drivers that are paying between $4,000 and $7,000 for basic insurance. Now, you balance that against what the penalty is for driving without insurance, which is $2,500. So if you're paying, say, $5,000-$6,000 for insurance, for basic insurance, that's not covering your additional coverage. And if you get caught for driving without insurance, your penalty is going to be $2,500. There are some people that are going to take a chance. They're just not going to buy the insurance because they can't afford it. And so that would be my point here, is that we have to monitor that grid. And, we've looked at some global numbers here in terms of loss cost and how many risks are ceded to the grid. And I'm not discounting that. It's all important data that we've got to evaluate in looking at the rates on the grid. But there is a point where you're going to start creating a dynamic where people are simply not going to buy it. And the risk to and that's a risk to consumers. It's not just a risk to that individual that may then get charged for driving without insurance. Because I have talked to people that got into an accident with someone that didn't have insurance, and if they've got collision coverage, then their own insurer is going to pick it up. But if they're not carrying collision coverage, and the people that aren't carrying collision tend to be lower income Albertans, the people that are driving the old vehicle, they're only carrying the basic insurance because that's all they can afford. So then they get in an accident with someone who's not carrying insurance, and they're on the hook for their damage. They've got to replace their vehicle. So it has a broader implication than just worrying about those. I mean, none of us like those drivers that we wish weren't on the road or we wish they'd changed their behavior, but we still have to deal with them in order to protect all the Albertans. How does Alberta stack up in terms of what our insurance premiums are compared to other provinces? Ours is the first one there. The average written premium, so that includes basic and additional insurance, $1,113 on an average basis. The one that stands out on that chart, of course, is Ontario at $1,524. The maritime provinces are, significantly lower than Alberta, running more in the 700s. I think the Newfoundland is $1,000. We know in Alberta, everybody came from either BC or Saskatchewan. Well, I guess now there's a lot of people that came from the Maritimes, but they fly home every 2 weeks. So everybody, if you talk to people that carried insurance in other provinces, they talk about BC and Saskatchewan. Those are sort of their benchmarks as to what they compare to. And so if you compare Alberta's average premium at $1,113 to BC at $1,130, they're pretty darn close. And Saskatchewan is lower at $910. Now, every year when I put these numbers up, these aren't directly comparable, and I acknowledge that. They're different components are included. BC includes commercial vehicles, for example, whereas our number is just private passenger. Saskatchewan has different coverage than Alberta, so we're not entirely comparing apples to apples. But when you're talking to the consumers, all they talk about is the premium, and they're not into the technicalities of what's included and what's not included. So it gives you an idea of where we stack up. These are traffic safety data, and they track to the insurance data. And so I just find it interesting to find a different source of information other than the insurance information to see if it's giving the same message. And I think that Facility presented similar data. The only difference is here I've done it incidents per 10,000 population. So that's taken into account the fact that we've got an increasing population, because you're going on an actual number basis. You are going to have an increase in the number of accidents just because you've got more people. But so these numbers have already factored that in. And so you see injury collisions have decreased, and property damage only have also decreased over the time period from 2008. And one point I'd make on the property damage, there was a change around 2010 in terms of the threshold for reporting accidents to the police, and so the number appears to be a larger decrease than in reality it really was. Distracted driving. Now, this was one of the questions that we raised with consumers, and one that Transportation Safety Services asked us to investigate. Just for those of you that aren't from Alberta, currently the penalties for distracted driving are a $172 fine, and there's no demerits. So the question to consumers was, are those penalties adequate to discourage people from distracted driving? And 83% of the people that we surveyed didn't feel that the penalties were adequate. They felt that people were still driving, texting while they're going, doing whatever else they're doing, just like the my daughter there in the picture. It's not my daughter, but it could be. You get to the point you don't want to text her anytime around when she might be driving home from work because you're afraid she's going to answer. And in talking to consumers consistent, and I think Chris would bear this out with me, it was everyone that we talked to in the focus groups and the telephone interviews were totally in support with putting in demerits for distracted driving as an increased incentive for compliance. And there was one individual that I talked to on the telephone. Who are the people that are going to take calls from you in July in the evening? And some of them are people that have had medical injuries, and so they're not going anywhere. And one of those that I talked to was a young fellow. He'd been a heavy-duty mechanic, drove a motorcycle. He was hit by a woman who blew through a stop sign while she was texting. And so that person is no longer working as a heavy-duty mechanic. He's trying to get some retraining, go back to school. So he had very strong views about distracted driving. It had changed his life very dramatically. He hadn't been working for 2 years, just had been, getting medical treatments and so on. Shopping around. Of the people that we surveyed, 35% of the consumers polled obtained a competitive quote for insurance, and of those, 86% stayed with their existing insurance. So, again, we compare to 2005, 58% were shopping around. So, again, it indicates relative satisfaction with the rates. Our survey indicated that consumers continue to rely on their broker or direct writer for quotes. I'm not sure if anyone here is from the Brokers Association, but I guess that's good news for the brokers. Consumers view them as being still their most valuable source. And in talking to the focus groups a bit about online quoting, how people shopped around for insurance, the feedback that we got was that the online quoting only takes you so far. You get some kind of an idea, it's kind of a tickler in terms of what firm or what company might be interesting to investigate, but that in the end you had to talk to somebody. You had to get on the phone and get through more detail. And so they weren't that thrilled with the online quoting as being kind of a one-stop shop. Usage-based insurance. Now that's, for the industry is a very, very significant change to the way that insurance can be calculated. And I'm sure most of you are reasonably aware of what usage-based insurance is, where you've got a device that is put into your vehicle, and the device tracks what your driving patterns are, what time of day you're traveling, what your speed is, braking, acceleration. So we just wanted to test consumers as to how they felt about it. At this point, usage-based insurance has not been approved for use by insurance companies, or is it provided as that insurance companies cannot offer that as an option to consumers at this point in time. But the superintendent's office is reviewing that, and so there's a reasonable likelihood that that's going to be approved over some period of time. But the question to consumers is, how do you feel about it? And what are the kinds of considerations that you would have if we're going to allow insurance companies to introduce it? The concept is that if you're, for good drivers or people that are driving in conservatively, so think, not rush hour, not 1 o'clock in the morning, in their own neighborhood, not driving downtown, they stand to benefit from usage-based insurance. As it becomes more pervasive, so that it becomes sort of a standard that everybody is using usage-based insurance, there is some risk that drivers with a poor driving record will pay more than they do under current plans, or those people that opt out, that say for privacy issues, or they just don't like it, they're just not going to participate. I think that there is a risk that those people are going to end up paying proportionately more than those that opt to go with the usage-based insurance. And so it again comes back to my issue about insurance is intended to be a product that the good drivers do pay for the ones that have the accident. Someone's got to pay for it. That's the idea of insurance. And so I think as a board, there needs to be an awareness of this and to make sure that there isn't so much segmentation that we've then got a group of drivers that are paying too much for their insurance and they're then making the choice to not carry insurance. Certainly when we talk to consumers about usage-based insurance, they were interested and potentially would even participate in it. But there was a lot of concern about Big Brother, that what are insurance companies going to do with this data? And, and obviously there's insurance companies in the room, but unfortunately there's not a huge trust of insurance companies. And that may not be news to you. But we really got that feedback. Just very much any time that someone is getting access to the data, and what assurances do they have that the data is not going to be used for other purposes? So I think that there's a message out of that. First, if insurance companies are going to be allowed to use it, that there needs to be some restrictions on how the data can be used. And I think the message for insurers is to tread softly with the consumers and give them lots of information as to how it's being used, what protection they've got, and so on. And the feedback from the Brokers Association, their concept would be that it would be more desirable to have a universal platform, that there would be one base of data that they could access. Because you've got other issues, too, of transportability. If somebody has got records with one insurer and they switch to another insurer, what happened to the usage-based insurance data and how is that treated? So lots of things to think about as we get into this brave new world of UBI. As far as the change to the regulatory process, I think that consumers, when we surveyed them last year about their feelings about the rate board regulating additional coverage, they were supportive, and so the fact that that's now in place, I think that that's a good news story for consumers. And I think the other positive is that this gives a better opportunity to rebalance the rates between mandatory and additional coverage. That I think that there's been a mismatch that's developed over the years where we've just been regulating the basic insurance, and so we're hopeful that can be regulated or can be rebalanced over the next year or two. So my conclusions, I would say that auto insurance is affordable for most drivers, that rates are stable, the total premiums have increased by less than 1% since 2005, and that the all-comers rule continues to be effective in making insurance available. And considerations for the rate board say gradual increases in rates are preferable to a significant hike in 1 year. So as we're looking at individual filings, if there's a big jump that we need to work that out with the insurer to make sure that we're not looking at dramatic increases for consumers in 1 year. And if UBI is introduced, to ensure that rates for non-participants are fair. And I think particularly for additional coverage where there is no grid to protect them. And my other point would be, as we're looking at rates on the grid, increases to the grid, that rates for new drivers and those with poor driving records need to be fair and not punitive. That we want people to carry insurance. We don't want the rates to be so high, saying you're a poor driver, and so therefore we're going to punish you by charging you huge rates. Even if you might like to do that, it isn't going to work for the whole system. So there needs to be a ceiling on the grid, and I think there needs to be some good discussion as to what are realistic ceilings, how much can people afford to pay. So that's my presentation, and be happy to answer any questions.
Thank you. Any questions, Emerald? You got the fear in them again. Having no questions, thank you very much.
All right.
Oh, sorry, I have one question from your patron.
Just because I joined the process with Merle this year, I'd just like to make a couple of comments from my observations, if you don't mind, Merle.
Oh, by all means.
And support them if you like. First of all, I thought it was a great barometer for getting feedback from the consumer. And I thought, so that process I think was excellent. On the UBI, would you, I don't know whether you would agree with this, but I felt that the consumers that we talked to and that you talked to on UBI, on user-based insurance, a lot of people mentioned about being a collaborative process as opposed to a marketing process. That they wanted to be involved in the process on an ongoing situation so they knew what their driving habits were and the resulting effect of those. Would you say that was a...
Yeah, right. Rather than just, like just getting a device for 6 weeks determines your rate and that's it. They would rather have it continuous so that they continue to monitor their driving habits. Yeah, I think that was another message. Yeah.
And the other thing that I also noticed that maybe it was because we talked a lot about insurance is that there seemed to be a dearth of information from the consumer. They wanted more communication from their insurance company about how their policy was made up, the resulting effect of an accident, or the resulting effect of a conviction, or how their premium was actually derived at. Would you say that was a...
Yeah, fair comment. Yeah, that was another takeaway. Yeah.
Okay. Thank you. It's nice that 1% was very interesting. It brings back to Ralph Klein's comment when this board was formed 9 years ago that this board would keep insurance rates competitive, and we certainly have at 1% over that period of time. All right, I'd call on TD next, please. Would we have three: Jean Roy, Ted Clough, and Lynn Whitehead. And you can sort out which one's which.
Don't worry, I'll do introductions.
Okay, you look after them, will you?
I'll look after them, yeah. Sorry. Yes, okay. Okay. Well, good afternoon. We are the last presentation of the day, but we are very pleased to be here today to speak to you during this new revised annual rate board review, and also give our opinion on the overall view of the severity and frequency and impact on the economic climate. I will introduce myself first. My name is Lynn Whitehead, Manager of Government Relations, and I brought with me my two colleagues, Jean Roy, from Vice President of Rating and Classification, and Ted Clough, Vice President of Claims Management of our Western region. Before I turn it over to each one of these gentlemen's respective areas, I would like to provide you a brief overview of TD Insurance and TD Bank in general, and the role that we play within the Alberta market. So, TD Insurance is a member of the TD Bank Group. We are the second largest financial service organization in Canada, and we are, TD Insurance, the largest direct response insurer. And in Alberta, we actually hold the second largest insurance. Our current market share is 15.82%. It has steadily increased over the last 10 to 12 years. And it is continuing to grow as we specialize in group insurance. We currently service over 296,000 active automobile policies, which represents, from last year, $507 million in written premiums. And that is serviced by our two offices, one in Calgary, one in Edmonton, employing more than 590 individuals. Okay. TD Insurance, as I mentioned to you, is part of the TD Bank Group, sixth largest bank in North America by branches. And we employ over 86,000 individuals worldwide. And as of April 2013, we were named the safest bank in North America by the Global Finance magazine. So that I'd now like to turn the floor over to Ted, who will be providing you with our reviews and views on current loss trends within the industry.
Thank you, Lynn. So our objective today is to provide the board with the latest trends available from our internal data, and this is factual data using the most recent information as of April of 2014. Loss data for the most recent 6-month period, November to April, November 2013 to April 2014, is compared to our prior full year period. That's November 2012 to October 2013. That's our fiscal year, and it removes any bias due to seasonality. There's been it's important to point out there's been no change in our internal claims processes throughout the period referenced. Thank you, Lynn. So this slide shows a summary of our frequency and severity changes during that 6-month period, November 2013 to April 2014. In bodily injury, we've had a frequency change of a frequency increase of 0.6% and a severity increase of 3.4%. In third-party property damage, 0.9% increase in frequency and 4.9% severity change increase. And accident benefits, again, 0.6% increase, and in severity, 5.7% increase. We wanted to point out that the impact of climate change in recent years should be considered when selecting trends for all coverages. And it's important to note that there may be an emergence of claims in subsequent years considering the potential development occurring from severe winters in recent years. We were discussing this morning, and we note that 3 out of the 4 past winters have been more severe than normal, and that this might suggest that severe winters are becoming more the norm than the exception. So claims frequency has a direct link to record snowfall amounts in our recent winters. So it might be prudent to properly evaluate what a good or bad winter actually looks like moving forward. In our severity experience in bodily injury, a severity increase of 3.4%, as I mentioned earlier, is partially explained by a number of factors. You've heard reference to the Sparrowhawk decision from Alberta Court of Queen's Bench from January of 2012 that held specifically that the jaw injuries to which you've heard reference a number of times today are not included in the minor injury cap. We're seeing new heads of damage being presented, things like housekeeping that were not present in the past. We're experiencing more plaintiffs' counsel developing strategies to avoid the cap on claims, including building up claims by increasing the use of psychological experts to increase general damages, as well as characterizing claims as chronic wherever possible. We're seeing an increase in prejudgment interest awards, general damage awards, and costs and disbursements for plaintiff counsel. And while accident benefits costs are not directly related to third-party claims experience, the increasing severity of accident benefits claims affects the number of bodily injury claims that may exceed the minor injury cap. Moving on severity. In property damage, that severity increase of 4.9% can be partially explained by some of the following factors. Alberta is expected to have one of the strongest economies among the provinces, among all of the provinces in coming years. So we can expect inflationary pressure on average body shop labor rates, material costs, and we see those leading to an increase in severity trends for property damage. In our accident benefits world, that increase of 5.7% is attributable to things like an increase in massage and chiropractic treatment costs, an increase in the number of the aforementioned jaw pain claims being made under accident benefits coverage, an increase of a referral for psychological evaluations and treatments, and there's uncertainty as to the extent that they will continue to impact accident benefits severity going forward. And finally, we've heard a lot about the economic climate in Alberta and the effect on claims costs. We've said that Alberta is expected to once again have one of the strongest economies among all of the provinces. Alberta is among the provinces with the highest employment rates in Canada. With lower unemployment rates, we would expect to observe an increase in health and repair costs, and we have also observed an increase in wages in recent years, relating back again to labor rates in property damage claims. And our strong labor market suggests that claims costs will continue to rise. We can expect inflationary pressure again on average body shop labor rates and escalating labor and material costs that will likely lead to an increase in claim severity trends in the future. Jean.
Yes. So I'll comment on the Oliver Wyman report that was presented to the board with our view on it. Overall, we're in agreement with most of the conclusions that the report is presenting, as well as the assumptions that are underlying. We're happy to see, because our own trend, as Ted has mentioned, are positive, that the board's actuary is also seeing the same kind of trend. There is some uncertainty in the estimated loss costs as well as a trend, especially on the BI side. There's been quite some time spent this morning between Dr. Miller and Mrs. Subilaki on where that could be ending up. So just pass on to the next one. I'll talk first on the trend side, and then I'll move on to the loss development side, because they're both parts of the same equation as to where the cost will be in the future. The report from Oliver Wyman does provide a range of estimates, as well as Dr. Miller mentioned a little bit earlier that the companies do have a variety of experience across the years. TD being a direct writer, we tend to be especially in the urban centers and in the major urban centers. So in the province of Alberta, we're especially in Calgary, an area that has its own challenges from a weather perspective. So as you look upon the individual company's experience, we encourage you to take those distribution differences of the various company into effect. In our case, we're especially hit by hail, because we are very present in the region of Calgary. But more importantly for the board, there is a wide range of even within the industry as a whole, there's a wide range of estimates that can be made for each of the coverage. So TPL, BI, and PD, as well as the physical damage, comprehensive, and collision, have a range that goes from, I'm taking collision, which is something that does not have a lot of variability due to estimates. It goes from 0.9 to 4.2 in the estimates of Oliver Wyman, and you heard a little bit earlier that Dr. Miller actually came in with a 0% change in the frequency. So important to take that into account. On the estimates of TPL BI specifically, again this year there's been a revision from both IBC as well as Oliver Wyman of the ultimate costs, not just of the latest year, but the series of years that have been presented from the original estimate that was there.
I think there's quite a bit of uncertainty. It was mentioned in the report from Oliver Wyman around the 2013 year. It's a year that's quite early. So we would suggest to the board that you tend to take, based on the history that's been there, a rather conservative view of what's been going on. And I'll refer to a statement that Mrs. Taylor made a little bit earlier, that the consumers do not like large increases over time. So small and steady increases is probably something that would serve them better. And to do that, you cannot take a very aggressive view of your estimated costs, especially for the latest year. I'll pass it back to Lynn to close.
Okay. So as you just heard from our presentation, and Jean just referenced the point, TDI supports a very balanced approach. We're looking for the board, and we recommend to the board that they weigh in reviewing individual company rate filings. It's important to consider the soundness of the Alberta economy, as well as the drivers that could potentially still continue to influence the rates, the long-term trends of past claims reporting, the increases that may have not have been realized yet, and the impact to those consumers. And therefore, the more gradual approach is a suggested approach, and it will prevent more significant increases being needed to be seen in the future. And we ask that any additional rate increases that are made are done to align themselves with the continuing claims costs and labor expenses. And that does conclude our presentation, and I would now like to turn it over and ask if there's any questions.
Thank you very much. Does the staff have any questions? Questions from the ladies gallery? No questions? Yeah. Yeah, sorry, Burl.
I wondered, you commented that you're expecting increases in body shop rates and so on. I just offer the comment that in some number of years ago, maybe 3 or 4, when I talked to consumers, there had been some real issues about getting their vehicles repaired, that there just weren't enough body shops, big problems. And my experience in the last year or two hasn't been that way. Anyone that has had an accident, it was smooth, they just got fixed. So I just wonder what you're seeing as far as the pressures on those rates and on the supply of body shops.
So it's an interesting comment that you make, that in the last year, consumers have felt that repairs have gone more smoothly or quickly. That isn't necessarily what we see overall. We still find it to be a shortage in the availability of repair facilities. However, I can only speak for our company. We made a concerted effort to speed up the repair time on non-drivable vehicles, and maybe slowing down the flow in of drivable vehicles. A great example is the hailstorm in AIRB a couple of weeks ago. We were writing off hundreds of vehicles. Well, they're drivable, and we're not writing them all off, but a lot of them are damaged. They don't need to be repaired quickly, so we're trying to get in those where consumers need a rental vehicle, quick repairs, and out. We still feel pressure in booking in repairs into repair facilities. Again, remember, as Jean referenced, our book is largely urban, where it may be more difficult. The booking in times are longer for repairs than possibly in smaller towns.
Chris?
Firstly, thank you very much for coming. I think it's really appreciated here directly from the insurance company, so I think that was great. Secondly, I think one would be fair to say, as the leader in the marketplace, you have an influence on the marketplace. And so my questions are related to premium and mitigating the losses. So firstly, everybody seems to want to focus on premium inadequacy, but we haven't really addressed mitigating losses. So if we address the catastrophe and we address BI development, okay? So looking at those two areas, I address it to you generally. So first of all, looking at the catastrophe losses, we've seen, obviously everybody has talked about the increasing catastrophes, and that's a fact, and I think the fact will be that will continue in the years to come. Whether we call it global warming or whatever we call it, it's changing. So first of all, my question will be, how has TD addressed the catastrophe losses in the years to come? Have you altered any of your procedures? Have you said, how do I mitigate these losses? How do I involve the consumer? So if you could address that one first.
Sure. Well, so catastrophe events tend to affect the damage claims, not injury claims. So we, in terms of service, we have rewritten and really reintroduced what we call our CAT plan or our CAT playbook in order to provide quicker, better service to our customers when they have claims in catastrophe events. In terms of mitigation, from a claims perspective, there isn't a lot. A hailstorm is a hailstorm. I saw vehicles coming in to our appraisal center with literally every panel battered and damaged. There's nothing we can do about mitigating the cost of a claim in a catastrophe event such as that.
Okay. In particular, there's new repair facilities that can pull out dents as opposed to heavy.
Oh, sure, yeah. Those are, in fact, we have our mobile claims response unit is up in AIRB right now at one of those shops where, sure, that's a new technology that is helping. I must say, in an event like AIRB, not as much help as it could be. Again, Chris, the cars that I've seen are absolutely annihilated by hail. So that technology is a good one, and it does help with small dents or small hail events. This one, a little bit less so.
Thank you. Any further?
If I may just add a little bit. You probably know that TD Insurance, just like a number of insurance company in Alberta, is participating in a hail seeding effort to try and diminish the size of the hail, essentially, that's falling, make it fall either in water or smaller hail size. Ourselves, as well as a few other companies in North America, are also investing in a piece of research to try and figure out if it is successful, right? That is a very long debate. There was a television piece on the CBC about a year ago that even within the scientist community, it's still uncertain whether or not the weather modification essentially is being successful. So we're investing a little bit in research to try and figure out, one, is it being successful? Two, is the weather changing from a hail perspective in terms of car insurance? That's an issue for us. As well as, are there areas that are more at risk than others? We tend to be seeing the results when there's actually insured, I'll call them assets, either a house or a car, something that is getting damaged. There's some information from as the city of Calgary is spreading out, as the city of Red Deer is spreading out, areas that were agriculture before, where hail would fall but no damage would be seen. There are now cars, there are now houses over there, so it's important for us, in order to charge the right price, but also do some mitigation with our insured to know where this is happening and whether or not it is changing from one area to another.
Okay, thank you.
Good. Question? I've just an observation. I was coming out of Calgary on Monday. I think it may be up somewhere up on the highway. There's a big sign that says, hail damaged cars for sale. Is that their own, or do they buy them back, or how does that happen?
It's not. Those aren't. That's somebody that's purchasing damaged cars. So again, I'll reference a car I saw last week. Perfectly drivable vehicle that we paid $12,000 as a write-off to the owner because the cost to repair it would exceed its value. So somebody is probably buying those vehicles off of the owners and then trying to resell them as damaged. Because again, perfectly drivable vehicles. If you don't mind driving a vehicle that looks like a golf ball covered with dimples.
Question?
We've heard a number of presenters talk about the grid, and in a couple of written submissions we've had from State Farms and Intact talk about it as well. So provide an opinion of what needs to be done. Does TD have an opinion of what should be done with the grid in terms of rates?
I think my friends from IBC had a great statement that the grid is essentially a public policy piece from the government. It's a balance between. I'm hoping I'm going to go in the right place here. It's a balance between affordability and ensuring that the customer are paying their fair share of the risk they bring to the insurance policy. I think the balance is something that is more of a view of the public policy than it is for us as an insurance company.
Thank you, Mark.
Well, thank you very much. We appreciate your presentation. It was well done, and it was very, very, very informative to us. We'll be meeting, and you'll hear from us in time. So thank you very much for coming in.
Thank you.
All right, that adjourns our meeting for today, unless there's something else that I've missed, and the board will be going to a board meeting upstairs. Is that right,
I know, you might as well capitalize on the opportunity as it presented.
What are we? 20 minutes over. 20 minutes over. 20 minutes over.